The U.S. is flooding the market with what they have in their reserves. We'll see how they frame this, considering the fact that in some ways, this takes the pressure off.
I have one question, Tom Keane. Will this meeting last more than the last meeting?
You brought that up yesterday. That was very, very good.
13 minutes earlier this month.
Yeah.
Come on, Tom.
That interview, this is with the United Arab Emirates oil minister, who's really quite good, out of the University of Tulsa. John, he really, really didn't budge from the linkage of Russia to the Persian Gulf.
Tom, is it about politics? Is it about economics? Is it about the oil market? And is this reserve release, Tom, if it develops in the way that we're reporting, does it change anything?
Maybe as Dr. Bremer,
you've pushed back against.
Maybe as Dr. Bremer said, it's every nation for themselves. Right now, a treat. Richard Haass is the president of the Council on Foreign Relations, and far more than that, with his public service to the nation in Northern Ireland negotiations. Ambassador Haass joins us with my book of the summer, a number of summers ago, The World, a brief introduction. Clearly, it needs a rewrite. Haass rumored to have a book out in January. We're thrilled the ambassador could join us this morning. Richard Haass, in your newest essay, See It, Folks, at my favorite project, Syndicate, you talk beautifully about American overreach. There's all these phrases in the Richard Haass world: the clash of civilizations, the post-American world, and now American overreach. What will our new overreach look like?
Well, this had become an assumption, Tom, in the wake of Afghanistan and the 2003 Iraq War, that the biggest problem facing American foreign policy is we were trying to do too much. Now you have the Russian invasion of Ukraine, and it's a reminder that classic geopolitics have not gone away, and that the new danger might not be overreach, but might be underreach, which is simply another word for retrenchment or isolationism. And we've seen voices calling for that in both parties. And I actually think one of the things coming out of this crisis is going to be a new equilibrium. We've already seen some new signs of that, some initial signs of that in the administration's budget. National security spending is going to go up. But the United States now faces a world of a Russian threat to Europe, Chinese assertiveness, at least in the Asia-Pacific. Iran has not given up its nuclear ambitions. North Korea is expanding its nuclear and missile capabilities. You've got a raft of other global challenges. Suddenly the world looks to be a very dangerous place. The United States has got to address it.
The new isolationism, it can't be the Chicago Tribune isolationism of our parents, Richard Haass. With the modern technology, the speed of information, the reporting of intelligence by the United States and the UK of Putin, the speed of news here means it's a new isolationism. How do you see that playing out?
Well, it makes no sense. Think about it, Tom. We're just 2 years out of a virus that began in Wuhan, China, and killed nearly 1 million Americans. Climate change affects us every day. We just marked the 20th anniversary of 9/11. To be isolationist in a global world, globalization's a reality. It's not a choice. The choice is how we deal with it. So American isolationism now is truly, truly a self-defeating and dangerous fallacy.
Richard, let's talk about the here and now right now, about these conflicts, this war in Ukraine, and what this does to the world order as you see it. If we're talking in big geopolitical strategy terms, how much is there a winner and how much is there a loser?
Well, there's more losers than winners, which is almost always the case in war. That said, NATO's come out of it in much better shape than it was. I think the Biden administration has handled this fairly well for the most part. The EU looks pretty good. Germany, what a turnaround. Ukraine is both tremendous resilience, but look at the destruction to the physical plant of the country. A quarter of the people are now homeless, either displaced or refugees. I think, though, the big loser, more than anything else, will be Russia. Look what Russia has done to its position in the world, to its economy. It's beginning to lose some of its best and brightest, and its army looks like a Potemkin military. So out of all of this, I'd say Russia's the biggest loser, but also increasingly a dangerous loser. We don't know how Mr. Putin might react to this, how he might lash out, how he might even escalate.
When you talk about how NATO is a winner, and Germany in particular, as they try to strengthen their place, what's your view on how lasting this move away from Russian oil will be? How much can the Western nations actually effectuate some replacement for that nation's reserves?
It's a great question. There's two parts to it. One is the physical part of transitioning out of dependence on Russian gas in particular. We're talking about years. In this country, we're going to have to build the ability to export liquefied natural gas. Europe's going to have to build the capacity to import it at scale. That's something that happens over years, not months or weeks. And then the question is whether the politics are there. That depends, I think, on what Russia looks like over time. Do we get to a post-Putin period? If we do, I expect there'll be voices in Germany that'll say we can now relax some of the sanctions. Some of the old fissures within the Western alliance will begin to reemerge if you see a changed Russia. But at the moment, we can't count on that. That's not a strategy. That's simply a hope.
Richard Haass, were the realists correct? Was John Mearsheimer and the others publishing in your magazine? You provided leadership on this debate. Were the Realpolitik crew correct?
Tom, I think this is one of these debates about whether we mishandled the end of the Cold War. It's going to go on for some time. This is one of those rare cases that even hindsight isn't 20/20. My own view is we did mishandle in some ways dealing with the Russia in the years after the collapse of the Soviet Union, the end of the Cold War. But I also would point out that doesn't in any way justify or explain what Vladimir Putin has done. You could say both ways. We mishandled some of the post-Cold War diplomacy, but in no way does that justify or warrant what Putin did.
Ambassador, let's get down to the nitty-gritty. In 2008, I believe it was at Bratislava. I could be wrong on that. I can't remember where the meeting was.
Bucharest.
Yeah, thank you. It started with a B. What do I know? The answer is Condi Rice and Richard Gates got hammered. They didn't listen to the pros about what to do on the Eastern Front. Are they going to listen this time to the pros that are nurtured by institutions like what you've built at CFR? Full disclosure, folks, I'm a member of CFR, so I'm talking my book. But they didn't listen in 2008, did they?
But, Tom, the foreign policy establishment was divided. You had Democrats in the Clinton administration. Madeleine Albright, may her memory be for a blessing, was one of the advocates of NATO enlargement. So was Brzezinski. Condi Rice, as you say, in 2008 in Bucharest with Steve Hadley. That was the view. Even now, you have people will say we should have done more NATO expansion. That's the problem, that NATO has never expanded to Ukraine. And then you have just the opposite point of view. We don't know what Russian political culture would have emerged as. So we don't know whether NATO enlargement and the mishandling of relations with Russia brought this about, or it would have come anyway. That's really one of those debates that won't end.
You sound like Nell Ferguson. Let's not do the counterfactual thing. Richard Haass, bring it forward for the next Secretary of State. Which way do they tilt, Rice or Albright?
I would say what we want to do is limit our involvement, if we can, in Europe. That's not the critical arena for the 21st century, Tom. I would say we want to free ourselves up as best we can to deal with China, the Indo-Pacific, and with global issues. The 21st century is ultimately not going to be decided in Europe. So what we need to do is manage things in Europe, put a ceiling on them so we can focus on global issues and on other geographies.
Richard Haass, a clinic, as always, of the Council on Foreign Relations. Richard, thank you. Thank you very much. Tom Keane, as Richard pointed out, there will always be disagreements over how this has been dealt with and how we will deal with it for years to come.
I want to suggest this, John, and I say this with great respect to everybody listening and hearing and everybody with 2020 hindsight and 2020 forward sight. The actual determinant in every moment like this is there's one guy, maybe a set of people that want to go rogue. And that's really what we're dealing with, is theories and chit-chatting and all that. But we're dealing with a guy that made a significant rogue decision, and that's always the case.
We're focused on that one guy right now. Mario Draghi, the Italian Prime Minister, had a call with Vladimir Putin.
Yeah,
Putin said this, Lisa, the EU companies could continue to pay for gas in euros and in dollars. Can you square what is going on here? This strange disagreement between the Europeans and the Russians in public, then on a phone call, all is okay, keep paying for gas in euros and dollars?
I'm making this up, but I think it goes something like this, where the Kremlin basically said, we're going to charge rubles. And basically Europe said, no, you're not. And they said, okay, because they don't have any leverage. I mean, how much is that really what's ultimately going on? They would love it to give strength to the ruble with some sort of proclamation and some sort of policy on this front, but it's not going to happen. And they can't give up the income that they get from Europe right now, and they don't want to really cannibalize from their future business there.
And the Europeans can't give up the gas, at least for now, because it's going to take years to get off it. In the meantime, Tom, we're all looking ahead to an address by the President of the United States a little bit later this morning. Expectations high about what he can do to soften the blow of higher gas prices in the United States. And the team here at Bloomberg reporting that we could see a monster reserve release at some point, and perhaps even announced today.
Scope and scale makes this different. I'm hugely skeptical of the value of these things, but I agree, John, the magnitude that we're going to see the President announce, that gets your attention.
But we've seen them do it a few times over the last few months, and it hasn't worked out. Crude snapped back again, so they're going even bigger, maybe, potentially, according to our reporting. Crude is down 6%. WTI 101.26 from New York City. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Biden administration may use the nation's strategic oil reserve to help fight inflation. Bloomberg has learned that the U.S. may release roughly 1 million barrels of oil per day for months to combat rising gasoline prices. The total release could be as much as 180 million barrels. President Biden is set to speak today on efforts on energy costs. Ukraine says talks with Russia are set to resume on Friday. The negotiations will take place via video conference. In-person talks in Turkey this week did not produce a ceasefire or major progress toward a broader peace deal. Now, Russia did agree to reduce military activity in northern Ukraine. In China, COVID lockdowns are stressing the economy and threatening global supply chains. Purchasing managers' indexes for March showed lockdowns in several cities cut factory activity. Meanwhile, COVID controls in Shanghai are impacting operations and reducing efficiency at the port. British companies will feel the bite of inflation. A record number of them expect to increase wages over the next year. According to the Lloyds Bank Business Barometer, a quarter intend to boost average wages by at least 2%. Now, a fifth of the businesses surveyed expect wage hikes of more than 5%. Another big payday for J.P. Morgan CEO Jamie Dimon. Dimon just received almost $56 million of J.P. Morgan stock before taxes. It comes from an incentive program the bank valued at less than half that much just 3 years ago. The latest windfall was held by the financial industry's surging business during the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I do think so far we're seeing clearly the situation in Ukraine has put inflationary pressures into the economy. You can see that in gas prices, wheat, aluminum, nickel, fertilizer. At the same time, I haven't yet seen the drop in demand.
Thomas Barkin of the Richmond Fed, speaking to Michael McKee in the last 24 hours from New York City this morning. Good morning. Futures are higher by a little more than 1/10% on the S&P. On the Nasdaq 100, up 0.4%. Yield shaping up as follows on a 10-year, down 3 basis points. Year to date through the first quarter, a monster move higher in the bond market. In terms of yields, 2s all the way out to 30s. Crude down by 6 percentage points to 101.20 as Bloomberg reports that we could have a monster crude reserve release from this administration. We'll talk more about that through the morning. But Tom, all of a sudden, consensus for this Federal Reserve is a 50 basis point move in May and again in June. And Mike Ferroli over at JP Morgan saying exactly the same thing in just the past day.
I would suggest it's non-linear. This will be the easy 50 basis point lift. After that, John, it'll be fascinating to see how it plays out. This is an easy lift.
The first one, maybe, Tom, but consensus is back to back.
Oh, more than back-to-back, yeah.
50 June. Citi and Andrew Hollenhorst think they do it 4 times.
Yeah, exactly.
50, 50, 50, 50, and then 25 after that for the rest of this year and into next year.
I would just suggest it's wicked, to use a phrase from Boston, it's wicked nonlinear as well. Right now, we're going to do this, and this is sort of odd. April Fool's, Jobs Day tomorrow. Usually it'd be like April 7, April 8. No, it's April 1. Everything's up front here. And we haven't talked enough about it. Rabila Faruqi joins us right now, Chief U.S. Economist, High Frequency Economics, where she and Carl Weinberg do just piercing analysis on the U.S. economy and the globe. Let's go to Jobs Day, Rabila. Is it a fully employed America?
You know, the job market is looking pretty strong in terms of job creation in and of itself. Over 500,000 3-month average. You've got an unemployment rate that is fast approaching the pre-pandemic level. The things that we are looking out for right now are participation in wages. And we saw moderation in wages in February. If we continue to see that going forward, it'll take maybe some of the pressure off. But participation is and civilian labor force coming back. That is something that we are concentrating on. But all in all, really the job market is looking pretty, has a lot of positive momentum.
My study of economic history is wage growth never, ever, ever, ever catches up with inflation. Am I right on that?
Well, I mean, there have been episodes where we've seen, just going into the pandemic where we had wages that were higher than the inflation rate. But right now, what we're seeing is huge distortion. So wages catching up with inflation or, prices. It's a big challenge. It's a big challenge for households. It's a big challenge for businesses. Right now, businesses are able to, pass on price increases, high input increases, wage increases in terms of higher prices to consumers. But how long that lasts is really an open question. We are really looking at the consumer to see when that pushback happens, and maybe that happens in February. If that then persists into March and April, then we're going to be looking at growth estimates being revised down. And that really does have implications. Right now, the Fed's message is very strong on inflation, to keep inflation expectations anchored. But really, the follow-through is where the question lies. We expect them to do 50 basis points in May and June. We expect another 25 in July. That takes 150 basis points total back, which is what they did at the start of the pandemic. But then beyond that, really, it's inflation matters, but also the growth trajectory matters. They certainly don't want to slow growth so much that the economy goes into recession.
Rubila, I was listening to Thomas Barkin yesterday of the Fed when he was talking about how the fact that companies can pass along some of the inflationary inputs to their own businesses to consumers is a negative, that pricing power actually gives him pause. How much will strong earnings from U.S. companies cause the Fed to go even faster than what people are expecting?
That's certainly a possibility, but I do think that there is going to be a pushback. I don't think companies are going to be able to pass on price increases forever. I think the consumer is extremely sensitive. Low-income households in particular are being hit really hard right now, from high energy, high gasoline, high food prices. And there doesn't seem to be any relief around the corner about that. So I do think that as they allocate larger and larger portions of their budgets towards these purchases, I do think that it will be pushback. I don't think companies are going to have unlimited power to pass on price increases.
What's the chance right now of a soft landing?
The million-dollar question. It's a very difficult thing. The Fed is in a very difficult spot. If they are as sensitive as we think they're going to be, I do think that they're going to pay attention. They're going to front load some rate hikes, and then they're going to be sensitive to how the economy and the labor market and inflation interact. So is it a possibility? Sure it is. History hasn't really been on their sides. There's only a few handful of instances where they've been able to do it. But we are still positive on the economic outlook for now. We still think that growth can come in around 2%, Q4, 3% calendar basis. But really, there is a wide range of uncertainty surrounding economic inflation and labor market outcomes.
Rubila, thank you. Rubila Faruqi there of High Frequency Economics. Just on the Fed's next move and then what on earth happens in the second half of this year. David Costin of Goldman, I caught up with him yesterday, Tom.
Yeah, tell us about that.
Get ready for negative earnings surprises for him, concentrated around the consumer in Q1. Something to look for.
Yeah, well, again, and this is the growth versus value simplicity, which doesn't capture the sector divergences. Doug Cass has been brilliant on this, John. It's just really simple. We said this yesterday. They're the winners. Mark Gurman out with an important Apple story this morning. Great. There's so many stocks that have dramatically underperformed. I guess that's normal.
Sure.
But I'm sorry. There's a lot of pain out there.
Would you like to pick one of them? I'll pick one of them. Home Depot, Tom, down 26% year to date.
I missed that.
There's one.
I did.
That's a struggle. That's the consumer.
You're shopping at Restoration Hardware. I'm shopping at Home Depot downstairs.
Well, you just told us earlier, Tom, you spent $20 on a chicken, so I've got no idea where you're doing your shopping.
I didn't. I just sent Afterthought out, and she went to, Dwayne Reed.
Where did she buy it?
She bought it like at the convenience store. I don't know.
For $19?
Probably somebody on the street.
I think maybe the youngest was lying to you about the cost of the chicken that she brought home, Tom. Did you ask for a receipt?
No, I got the charge. It was $115. It was 4 bags of Doritos and a chicken.
Yeah, I'm sure. Lisa, Home Depot down, the home builder's struggling. The year ahead for these kind of industries is going to get very interesting.
Especially because we already baked in so much momentum from the pandemic and the aftermath of that. At what point does that wane? At what point, again, I keep going back to this, the stock market is not the economy. So if the Fed wants to tighten financial conditions, are they effectively doing it? Are we measuring it correctly when we take a look at some of these large cap stocks that are kind of divorced from the underlying fundamentals a little bit when you look at how much AirPods cost?
Is it just equities supporting financial conditions right now, or is it something outside of stocks too?
Well, credit, right? But it's also held in because you've had so much refinancing and you've had basically this fortification of balance sheets. I honestly, this is a conundrum for the Fed. How much do they have to crimp consumer demand? How much do they want to see that heading into earnings?
Futures unchanged on the S&P. The Nasdaq slightly firmer, up 1/3%, closing out March and therefore closing out the first quarter. Yields are coming in by 4 basis points to 231 on a 10-year. From New York, this is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's always hard to predict what the Fed's going to do. It's even harder in an environment like this.
I still don't believe the Fed intends to cause any sort of economic recession by over-tightening.
It's remarkable how flat the curve is so early in the rate hiking cycle.
It's going to be really difficult for the Fed to hike rates aggressively.
You have to choose between recession or the anchoring inflation expectation. You cannot have a soft land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Closing out Q1 of 2022 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Futures unchanged on the S&P. Crude, Tom, anything but unchanged this morning.
Crude in front and center with the president speaking. I believe it's in the 1 o'clock hour this afternoon. John, I get it. It's an American story. We know what a gallon of gas costs. But I'm sorry, it is heating up in Europe as we enter the later part of this week. What is it, John? A chess match? Game of chicken between Germany, Italy, and Mr. Putin on the price of oil in the contracts.
And gas prices and what you pay for those gas prices in. Tom, what can we do about it? The administration, according to the team here at Bloomberg down in Washington, reporting that maybe we release 1 million barrels of oil a day for something up to 180 million barrels of oil. Tom, we've seen the movie a few times, just not on this scale.
I'm going to talk to Professor Will Kennedy, Professor Javier Blas about that. I'm skeptical as an amateur about any kind of long-term benefit from that. Maybe I'm wrong.
Lisa, WTI 100 and down 6% this morning.
You can push it even further. Tom saying he's not sure about any kind of benefit. What kind of vulnerability does that actually put the U.S. in heading into the summer months when people typically drive more, travel more? Also, what is going to be the process of rebuilding inventories, and what does that do to a market that already, by many accounts, is tight?
So far, so good for this economy. And speaking of tight, the labour market, how tight is that? Lisa, tomorrow, 490K is the estimate for payrolls, for unemployment, a tick lower to 3.7%.
This is what is causing some angst for the Federal Reserve. How does the Fed raise these numbers? Do they basically get more bold? Do we get even more hawkish? Can we get more hawkish, given the fact that right now, as Julian Emanuel said yesterday, the only bubble is in the bull market for how hawkish people are?
Tom, that's the call for the Fed. For this administration, TK, let's just sit on that for a moment. A 3.7% unemployment rate, and to see the president's approval rating as low as it is.
Yeah, it's stunning. And what's important there, John, there's select economists that say this economy is so powerful, even with all our challenges. Can you imagine, John, 2.9%? Some are thinking about that.
Possibly. And Tom, the issue the president and the White House has right now for this administration, the data point that matters is not that one. It's the CPI print. Inflation.
It's everything. I agree. I mean, before it was a talking point. You and Lisa have been great on it. But now it's exploded. But I'm sorry, this is a way bigger deal for ECB Lagarde in Europe than it is over here.
Did you hear Luis de Guindos of the ECB,
I missed
the vice president this morning? The headlines from him read as follows. He hopes the inflation peak is reached in 2 to 3 months. He still expects the economy to grow in 2022. If you're a central banker and you have to come out and say, I still expect the economy to grow in 2022, Lisa, doesn't that underline and emphasize how much of a problem they've got in Europe right now?
You don't want to hear your central banker saying, we still are hopeful that perhaps we can eke out some growth. You don't want to hear that at a time when people are talking about stagflation. Doesn't exactly imbue you with confidence.
Unreal. As we close out the month of March and Q1, here's the price action for you this morning on the final trading day of the first quarter of 2022. It's felt like a long one, let's put it that way. Futures unchanged on the S&P, on the Nasdaq up about 1/3%. Yields come in 4 basis points this morning, 231 on a 10-year. Euro dollar just about below 111, let's call it 110.98. We're down on that currency pair by 0.6%. We've talked up the move in crude, talked it down rather. Lisa down 6% on WTI.
Yeah, and really deteriorating throughout the morning as people assess the impact of this potential oil reserve release by the United States. Right now, the consortium of the biggest oil producers are gathering to talk about output. Perhaps it'll be more than 13 minutes long. How much does OPEC Plus use the oil reserve release that we're expecting from the United States as an excuse not to go further, right? I mean, how much does this basically give them a reprieve at a time when they really plan on only increasing output marginally in order to stay with their previous plans? At 8:30 a.m., the data dump. How tight is the U.S. labor market? We get U.S. initial jobless claims. How much can they continue to fall? We also get February personal income and spending data. How much does personal spending start to go down as we get the inflationary inputs? We are seeing on the margin some signs. Is Restoration Hardware the outlier that's giving the kitchen sink at their personal problems in terms of their business strategy? Or are we seeing real demand destruction as prices go up? And at 1:30 p.m., we find out exactly what the U.S. plan is for that oil reserve release. President Biden plans to speak. How much does he really emphasize bringing the price of gasoline down? $4.24 Tom will mention Mammoth in California and how the prices are much higher than that. How much has this become a linchpin heading into the midterm elections? And how much is this a strategic midterm release at this point right now, John?
Well, if it's that, Lisa, they're going to be doing it for a while, aren't they?
Well,
because the midterms are some months away.
Correct, which is probably why we might get to 180 million barrels. I'm tongue-in-cheek here a bit,
sure.
But how much is this a Band-Aid at a time when we're dealing with some deeper issues that policy has to be nuanced to fix, and it will take a long time to do so?
Bramo, thank you. Let's get to the team. Your team coverage starts right now with Bloomberg's Jack Fitzpatrick in Washington, Maria Tadeo in Budapest, Hungary. Let's start with you, Jack. What is Bloomberg reporting indicating about what we could hear a little bit later?
The basics are the consideration is about 1 million barrel per day release from the Strategic Petroleum Reserve. The maximum number that's been discussed is about 180 million barrels total over a number of months. They haven't put out the specifics on exactly the time range, but that is about a third of the oil that they've got in the Strategic Petroleum Reserve right now. They're still trying to lock down some sort of an agreement so that this is not the U.S. acting alone, and this is in conjunction with a broader international release of oil reserves. But those are the basic numbers that they've discussed now that they hope will make a difference over a matter of months.
Maria in Hungary today for the Hungarian election in Budapest. Thank you, Maria, today for joining us. Maria, you sent me a memo on the Draghi-Putin conversation, and I'm sorry, it's an out-of-body, non-political memo. This is Mr. Putin, KGB kind of guy, talking to the former head of the ECB with MIT chops, and your memo reads like a derivative swap contract. Does Mr. Putin speak differently to the financial guy from MIT than he does to Scholz and the rest?
Well, he probably did. And actually, if you looked at that press conference by Mario Draghi, he almost made it look like, and very ironically, that Putin did not know how to explain the payment system that he wants. Mario Draghi hinted that he was very confused at how this would work. He also said that Putin told him nothing would change for European companies, that the contracts in euros can still continue to be paid in euros. And then Mario Draghi added in a way that at times sounds a lot like Professor Draghi, saying, it is my impression, but I may be wrong, that swapping a contract, swapping currency, and swapping the way you cash it is difficult, but probably in breach of contract, but also in breach of sanctions.
Maria, do we have a sense of who has more leverage here, considering the fact that basically the Kremlin said, pay us in rubles, the European Union said no, and they said, okay.
Yeah, well, at one point, of course, someone's going to have to blink. But I cannot speak for what the Russian government is saying. Of course, they tell you that they can definitely change these contracts and that Europe will finally pay everything in rubles. But I can tell you that when I speak to my contacts in Brussels, they say this is a two-way street. If they cut the flows, okay, we're probably going into a recession. We're going to have a big problem in the winter. But this is a two-way street. At this point, Russia has half of its reserves that are frozen. They need to pay for a war effort. You know, the longer a war goes on, the more expensive it becomes. The economy of the Russian Federation is under immense pressure, and they need the cash. So what they believe is, at this point, faced with a choice, do we take euros, do we not cash the payment, and then, of course, not have money for ourselves? They're going to go for the euro. That is what the European Union believes. Ultimately, Russia will have to blink.
That's Europe. Let's finish on the United States. Jack Fitzpatrick, if the US unveils the plan that Bloomberg has described in our reporting overnight and this morning, does that confirm that the outreach to Riyadh failed?
It is probably a reflection of at least the mitigated expectations for OPEC and OPEC Plus that the U.S. hasn't gotten things to entirely go their way. There's still a broader conversation about who they can work with to get international releases of oil reserves or an increase in supply in some way. But yes, the fact that we're talking about this now is a reflection of at least some level of disappointment with OPEC and OPEC Plus.
Jane Fitzpatrick and Maria Tadeo, team coverage on the energy issues on both sides of the Atlantic. Tom, and they are issues, all right, big ones.
They are. They're big issues, and we're going to hear more about that. John, can I mention a corporate story as we were beating to death Restoration Hardware and the rest of it? Mark Gurman is definitive on Apple, and he has out the definitive story this morning on the First National Bank of Apple. John, this is what's coming down the road. I've got the wallet on my phone like everybody else, and it appears that Mr. Cook and all are going to try to do what Walmart failed to do, which is bring modern banking into their tech platform.
I'll go through that lead paragraph from Mark Gurman, Tom. Apple developing its own payment processing technology and infrastructure for future financial products, part of an ambitious effort that would reduce its reliance on outside partners over time. Tom, that according to people with knowledge of the matter.
John, I had no gray hair when grocery stores were talking about doing banking in grocery stores. It failed.
Yep.
There was the whole Dean Witter financial systems thing. It failed. If anybody's going to do this, do you bet on Apple?
I think I had hair back then as well, Tom. How's the credit card working out? How's that worked out, Tom? Can we start there? Because that's the first effort, isn't it?
Okay, I've been out on Twitter. I hate it with a passion.
Why do you hate it?
It's just clumsy.
What's clumsy about the credit card? You've got to tell us specifically.
It's like this, and it's like throw the phone. Just let me pay the damn bill.
Great for radio.
So you're saying you don't like the payments on the iPhone? That's not working out for you.
I just think they're working it. Like Gurman says, they're working at it.
Okay.
It's a work in progress.
Rich insight.
Tom Keen's personal thoughts on the card effort from the Apple iPhone.
I don't have the card. Vettel has.
Constructive. You send an email to Tim Apple and you let him know.
That's how I pay my Chewy bill.
Futures unchanged on the S&P from New York. This is Bloomberg.
Never a dull moment. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. The Biden administration is weighing a massive release of oil from U.S. reserves to fight inflation. Bloomberg's learned 1 million barrels of oil a day may be released for months for up to 180 million barrels. President Biden is set to speak today on efforts to reduce energy prices. Meanwhile, OPEC and its allies are refusing to engage with the energy crisis triggered by the war in Ukraine. At its meeting today, the OPEC Plus coalition is expected to stick to its schedule of gradual oil output increases. Now, that plan was reached last July and has been followed ever since. Saudi Arabia prioritized its relationship with Russia, which co-leads the OPEC Plus alliance. The White House says that Russian President Vladimir Putin has been misinformed about his advisors about his military's performance in Ukraine. Now, a spokeswoman says the same thing has happened regarding the impact of sanctions on the Russian economy. She said that's based on U.S. intelligence findings. Some of Europe's biggest airlines are renewing their call for more government aid and legislation to help the industry decarbonize. The CEOs of Lufthansa, British Airways owner IAG, EasyJet, and Ryanair, they gathered today in Brussels. They argued that money is needed as airlines make the costly transition to cleaner energy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, it's really important that the jobs recovery continues.
The March Jobs Report, Friday on Bloomberg Television and Radio.
There are already very standard deviation away, semi-black swan events on things like inflation, not just in the US, but also in Europe. Of course, we've had also this major geopolitical shock, that is the war, and it's just a symptom of a much broader geopolitical depression. We are in a very difficult situation where extreme things are happening.
Nouriel Roubini, and that's just the first quarter. As we wrap that up, futures unchanged on the S&P, the Nasdaq 100 positive, about 0.2%. It yields on 10s a little bit lower, down 3 basis points to 231.61. Crude down 5.8% to 101.60 as Bloomberg reports that we could get a monster reserve release from the administration. It could be announced later today. Happening right now is NATO Secretary General Jens Stoltenberg addressing an audience once again, Tom, of reporters and saying the following: Russia has repeatedly lied about its actions. Russia is regrouping for an offensive in the Donbass. Now, Tom, you remember earlier this week when talks wrapped up between Ukraine and Russia in Turkey, there was a pledge, a promise from the Russians that they would sharply cut operations around Ukraine's capital. Jens Stoltenberg, Tom, of NATO, suggesting that's just a regroup for an offensive in Donbass.
This is not just the gentleman from NATO, the former leader of Norway, John. This is everybody out there in the zeitgeist in the last 48 hours. And I'm going to give major credit to the British media and the British briefing from, I don't have the name, John. I believe it's Sir James Fleming is their head of security in your United Kingdom. But he is absolutely heated about their measurement of duplicity.
Those promises, Tom, met with skepticism worldwide. And we can go over point by point over the last 6 weeks where Russia has lied repeatedly. And Jens Stoltenberg is saying that again. They've lied repeatedly. We don't believe their actions. for anything other than to regroup and attack the Donbass. So, Tom, here we are. Actions on the ground speak for themselves.
We'll continue to follow that. Maria Tadeo today in Budapest. Right now, an exceptionally important brief on the dynamics of the equity market and how it correlates, if you will, to commodities, bonds, and the rest of the financial world. Mandy Zhu is Chief Equity Derivative Strategist at Credit Suisse and joins us. I was going to give you a new job, Chief Executive of Credit Suisse, but you don't want that headache. Mandy, I love your note, and what it comes down to is the known of the derivative space, which is in every case, it's always asymmetric. What is the lead asymmetry right now as we enter Q2?
What everyone is focused on in the derivatives market right now is the divergence that we're seeing between equities versus all the other asset classes, right? So over the past week, what we've seen is equity volatility continue to normalize. The VIX, sub 20 now. Whereas if you look across other asset classes, whether that's rates, credit, oil, gold, FX,
right.
Volatility continue to go higher in those asset classes. So, what is driving this divergence? And particularly, I would say, it is most pronounced between the rates market versus the equities market, where we're seeing in the rates market, implied volatility levels back to the March extremes. And actually, if you take a look back, longer history, outside of March 2020, you'd have to go back to the global financial crisis to see as much volatility being priced into the interest rate market.
You talk about normalized. So let's go from bell curve Gaussian out to Taleb's fat tails and a Poisson distribution. How are the tails doing right now in the different classes, particularly in the stock market?
So in the stock market, it's come in very significantly. It's not just the VIX that has normalized, it's measures of downside risk, for example, skew and convexity, measure of tail risk. One easy way that you can see that is if you look at Volatile, VVIX index, that's also come in, toward near-to-day lows. So, one of the trades that we like in this environment is looking at, upside in the VIX, taking advantage of that asymmetry that we're seeing in the equity market versus other asset classes and taking advantage of that reset lower of risk in the equity space.
Mandy, pulling this all together into something that is not in the Greek space, how much is this a bet that even though we're seeing unbelievable, unprecedented rates volatility, that's not going to be the main tail risk for markets, that will leave markets on the equity side much more stable over the long term? And how much is that wrong?
Right. So I would say, obviously, the yield curve inverting historically has been a very good, has a very good track record in terms of forecasting recession. But for it to be a tradable signal, you also need to have the timing aspect right. And I think where we're seeing the equity market is skepticism around the timing. How imminent are we going into that recession? Right. Historically, the lead time is around 2 years. Could it be even longer this time around? I would certainly say in the equity market, there is more optimism around, the Fed being able to kind of, rein in inflation without driving the economy into a recession. Whereas in the bond market, I think there's a very high amount of skepticism that that's going to be the case.
Mandy Zhu, awesome as always, of Credit Suisse Securities. Her colleague, Jonathan Golub, wrote this recently. Here's the quote. The Fed's projected path of rate hikes will not be enough to tame inflation, leaving the economy hot and stock returns strong. And Lisa, that's what many people believe. It won't be enough.
When he was looking at what the real rates were, they're deeply negative and going even more negative based on just the pace of inflation and the fact that the Fed has not moved more than 25 basis points. We have to keep reminding ourselves they just stopped buying bonds and their balance sheet is near record highs. So to give a sense of how easy monetary conditions are seems to be underpinning some of the optimism in the equity markets.
Let's just say expectations have changed a lot over the last 3 months about what this Fed will do in the coming meetings and, for that matter, through the rest of this year and into 2023. If you're waking up this morning, crude is the move you need to look at. WTI just about around 100 with a big move lower of about 6 percentage points following a story that we put out here at Bloomberg that this administration is considering a monster reserve release. A lot of people reacting to this, including Peter Bukva of Bleakley Advisory, who says this, Tom, in his note this morning: when something doesn't work, just do more of it, question mark, exclamation mark.
maybe a little harsh. I'm a big fan of Bookvar, but the
That's
answer,
what he says,
John,
Tom.
John, I know,
Me.
but John, look.
You were saying the same thing, Tom.
I've got a rattle in my desk
DK said
today.
the same
I don't know
thing.
what's going on. Vet
Tom,
Bill,
you said
be
the same
good.
thing literally an hour ago.
Yeah, he was basically like, this doesn't work.
We've seen this movie a few times.
And now he's like, oh, it's harsh.
What is this, Pile on Tom Day?
You disagree with it?
April Fool's is tomorrow, John. Look.
I'm not fooling.
What are you doing
What are
to your
you doing?
microphone?
Vet Bill's under here and his kennel's vibrating against, he's vibrating. I'm bringing my dog to work.
Get another kettle from Restoration
This is not going to
Hardware.
get you out of it.
John.
Would you like to tell us why you disagree with Peter Bookvar?
I don't disagree with Peter Bookvar. What I'm suggesting is to Golub's point, it's about nominal GDP. Look, growth 1%.
Sure.
Atlanta GDP
What's
now.
that got to do with crude?
Inflation 7%, which is 8% growth. That's why you can be optimistic like Golub.
Stop dancing around it. Why do you disagree about the crude reserve release? Why is that harsh?
So how many releases have we seen? I'll take your point, John. The magnitude of it's a big deal.
Thank you.
I take that point.
Futures, a little softer, down a tenth on S&P. I'm pleased you take that point. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
And breathe. What a first quarter. What a first month of January with a big sell-off in tech, then February, as we started to see an invasion of Russia in Ukraine.
I thought you meant the last
segment. Be
segment.
serious about the first quarter. That kind of encapsulates how the show has gone this morning. For March as well, the equity market up by more than 5% on the S&P 500. The biggest month of gains we're poised for since October this morning. Just a little softer, lighter, lower, negative, 0.1% on the S&P. On the Nasdaq, positive in the other direction by about 0.1% also. Big moves in the equity market. Tremendous moves in the bond market. Let's talk about it. Your two-year yield is up 85 basis points month to date. A massive move. We're starting to think about a 50 basis point hike at the Federal Reserve. It's consensus now. Mike Ferrotti of JP Morgan throwing in the towel, saying 50 at the next meeting, 50 after that. That didn't get my attention yesterday, this did. The ECB and a call from Capital Economics. 3 hikes this year, 5 next year, and we can get the depot rate of the ECB back to 150. Now think about that. That is an out of consensus call, by the way, in a big, big way. But let's say we can achieve those kind of rate hikes from the ECB, together with these kind of rate hikes from the Federal Reserve. Where does it take the global bond market, Tom? You've got to reprice bonds, you've got to reprice the whole European universe, which has been a massive anchor for the global bond market over the last 10 years. Tom, if we can deliver that, I've got no idea where this one goes.
We're going to discuss that with a leading authority here in a moment, John. And I want to say this, John, with immense respect by our team, particularly Aggie on the border in Poland, Maria and Anne-Marie working, and all of the agony we've seen in Ukraine. I'm not saying this is a joke. I'm saying this is a Q1 reality. Dollar ruble from 12.31 to 3.31 has barely budged, 75 to 82, and all that heartbreak is in between.
What kind of market is that, Tom? What kind of a market is it?
That's a market of crisis.
To what it was 3 months ago.
Market of war, market of crisis, that's all there is to it.
It's not a market.
Bramo, isn't that the point?
It's not a market.
Who's trading it?
I'm sorry. But at the same time, it's nice to quote as sort of a gauge of what Vladimir Putin would like to see in terms of the reflection of progress in the war. That's my sense.
Let's quote another one. Crude. WTI and Brent. Looks a little something like this. We're down about 5.5% on WTI to 101.97. We've seen this movie before. The administration comes out, releases crude reserves. Crude gaps lower, then gaps higher. Then they come out and do it again. Crude gaps lower, crude gaps higher. This time around, they go in bigger, Bramo. Does going bigger make a big difference?
Well, and look, we were harsh on Tom, and Tom, we didn't mean to pile on completely, but you did say scale does matter. This will matter in the short term. In the long term, though, does it have the opposite effect, John? And that, I think, is what a lot of people are wrapping their heads around, which is if they have to rebuild and there hasn't been a material change in the structure of the oil market, does that just kick prices right back up and then some?
I should say they're thinking about going bigger, according to our reporting. We'll find out a little bit later, potentially. Was that sympathy for TK?
Yeah, I mean, I feel bad. He's,
really?
He's playing with his, kennel. Once a year. I didn't mean to pile on. It's just that it seemed sort of
the softer side of Bramo. Crude right now, 102. That's across asset price section with some single names this morning. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Let's stick with crude. Of course, you're seeing crude prices down, and that's putting some downward pressure here on some of the oil and gas-related stocks. Occidental Petroleum down about 2.3%, but you talk about the end of the month, the end of the quarter. Occidental, that's your best performer in the S&P 500 this year, having more than doubled. In fact, as a group, energy is up 10% this month, about 40% year to date here, and that gives you a sense here of where investors' heads have been at. This has been the big winner on a year-to-date basis. In fact, you're not really going to find too many other stocks that have really outperformed in this market over the last couple of months. The top 20 stocks in the S&P 500 year-to-date are all energy-related or commodity-related, like Nucor. Nucor shares up about 0.8% here in the pre-market. As for one of the worst performers in the S&P 500 so far this year, that belongs to a lot of those high-valuation discretionary names, including Netflix. Netflix shares higher by about 0.4% here in the pre-market, but barring some unprecedented rally, Netflix headed for its worst quarterly performance going back to June of 2012. Keep it going here. Some things to keep your eye on the day here. AMD shares under pressure after a downgrade by Barclays to equal weight. Some concerns about the cyclical risk out there for some of these chip stocks. And keep an eye on the marijuana stocks. You're finally starting to see some potential progress here on federal legislation to decriminalize marijuana. A vote in the House could occur as soon as today or tomorrow. Sundial up about 5%. Tilray basically unchanged on the day. Erwin Simon, the CEO of Tilray, Tom's going to be joining me a little bit later this afternoon on Bloomberg Television.
Nice plug to close. Romaine Bostic this afternoon as well. It is the end of the quarter. We recalibrate, and George Saravelos, with a vengeance, recalibrates at Deutsche Bank. A note yesterday, an extensive note, going way against the emotion of Europe flat on its back. George Saravelos saying, buy euro, strong euro for 6 big figures. George, why will the euro appreciate?
Good morning, Tom. So I look at Eurodollar from 2 dimensions, the US and American side, the American side and the European side. If we start with the US, and of course a lot of focus on the Fed repricing, the key point for me is, as we go ahead now, every extra Fed hike that's going to be priced is going to be less and less supportive for the dollar. And the rationale is simple. The US is moving into a late cycle environment. We've been writing about these risks of curve inversion for a long time, and the curve did invert this week. But as that happens, as you have to price in even more Fed hikes, that's going to challenge the growth narrative, and it's really going to lead to a slowdown in inflows into the US. And if you look at some of these measures of the funding of the US current account deficit, they're already starting to deteriorate quite dramatically. So foreigners are just becoming less and less favorably inclined to go into the US. And then there's the other dimension, which is the European one. And here I don't think it's about whether the ECB goes in July or September, in December. It's, do we go back into positive rates? Because negative rates in Europe, in our view, have been the single most important driver of a weak euro over the last decade. It's led to huge shifts in capital flows. The entire European financial system has been structured around negative rates. And in just the space of a few weeks, you've seen nearly 80–90% of the German yield curve shift back to positive. And I think that's a hugely consequential event for the euro that should eventually mean significant appreciation.
Well, let's talk about what significant means. The summer of 2014 was when they took the deposit rate into negative territory at the ECB. That year, euro dollar was pushing 140, 139 at the highs. George, when you say significantly higher, what kind of number are you thinking about?
So that's exactly spot on, John. I use that period as an example of how big the impact was. If you go back to 2014-15, you were 135, and then within 12 to 18 months, you went all the way down to 105. And of course, there were other things happening back then, but if I look at the fundamental driver behind that weakness, it was a huge swing in European flows from plus 400 billion euros, helping the euro up at 135, 140 to negative 400 billion euros. So that's nearly $1 trillion swing in flows that pushed the euro down. And I'm not arguing this will happen overnight. It may well take months. It may take 2 or 3 years. But our long-term forecasts, which are premised on the European rate structure turning positive, critically staying there, European rates being able to reprice more, because if you look at the European fiscal picture, in contrast to the US, it looks much more favorable. If you take all of that and put it together, we have the euro moving back above 120 and eventually above 130.
George, can you see this playing out if the ECB is hiking into weakness and the EU is really facing a stagflationary force that leaves it in recession?
I think that's a really important question for the near term, and that's exactly why the euro has suffered over the last couple of months on the back of the Russia-Ukraine war. For us, it's all about the tail risk. Is the tail risk of more extreme outcomes, especially on the energy front, which would lead to a European recession, is that tail risk going up or down? And I think over the last week or so, we are seeing evidence that that tail risk is reducing. If it was to come back, it would definitely be a setback. But I would view that as a temporary setback in terms of the big picture drivers of the euro and indeed of European growth. Even if you were to see a recession, the medium-term outlook for Europe, I still think looks positive, especially with regard to fiscal policy. Defense spending is going up. The NGEU The new fund that was set up is still providing stimulus through this year and through next. And that's quite a big difference to the US, which I think is in more serious trouble from a more medium-term perspective.
George, just to wrap things up, can you be more specific about the rate path for the ECB from here? You talked about how important it is to get back to zero for the FX market, but where do you actually see this going?
So we have the first hike in September, then in December, and then keep going until at least 1.5. I would say the risks around that projection are to the upside. So earlier rate hikes and critically neutral rates in Europe, potentially repricing even more.
Amazing. George, thank you. George Saravelos of Deutsche Bank. That's the call from Deutsche Bank, Tom. Very similar to the call that Capital Economics have as well. You get back to 1.150 over at the ECB, and it could transform the European bond market and ultimately transform, potentially, the FX market too.
It's intellectually really fascinating. But, John, we have to remember, and I keep saying this, there's this surreal thing where the war is sort of, because we're in America, the war's sort of over there. The war's still going on, and day to day there's massive uncertainty, as we've seen with the discussions of Russia troops and the pressures on Kyiv.
I think Lisa asked the most important question.
Well, she always does. You never say that about me, but continue.
Well, for good reason. Is the outlook for growth going to be there to allow them to hike into?
Well,
that's the issue,
that's what
Lisa.
I'm struggling
and we had Thanos on yesterday from Bank of America. Van Vakidis, who basically said 105 on euro dollar, they're going to hike into weakness.
And they had the exact opposite call because of exactly what George Saravelos was talking about. How can the European economy handle 1.5% overnight rates at a time when so much of their market is still trading at negative yields? How can they survive this in terms of economic growth, given the sense that they've been relying on these negative yields?
Where's Italy, the Italian bond market, if we get?
Not in North Macedonia.
150.
Oh, boy. We're having a bit of
at
domestic.
The ECB. Given that the 2-year in Italy right now is 27 basis points.
2 years, that's when they get to compete again.
TK. No World Cup talk. If you're wondering why we've fallen out, this is it.
This is
Still texting me about it last night.
At what time?
He was telling me about which bar to go for the World Cup later this year in New York in Midtown.
Street.
Where's
That's
Happy
a reach.
Hour? He sent me a list of bars to watch the games in.
I was watching Big Jet.
Yeah,
777.
I don't know what you're drinking from New York. This is Bloomberg.
Well, it's Tang, but there's something added.
Have a cup of whatever he's having. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Biden administration may use the nation's strategic oil reserve to help fight inflation. Bloomberg has learned that the U.S. may release roughly 1 million barrels of oil per day for months to combat rising gasoline prices. The total release could be as much as 180 million barrels. President Biden is set to speak today on efforts on energy costs. Ukraine says talks with Russia are set to resume on Friday. The negotiations will take place via video conference. In-person talks in Turkey this week did not produce a ceasefire or major progress toward a broader peace deal. Russia did agree to reduce military activity in northern Ukraine. Barclays is the latest bank to raise compensation for its lowest-paid U.S. workers. Now, they'll get 21% pay hikes from $17 an hour to $20.50. It applies to more than 900 employees, primarily at Barclays Consumer Bank. Shares of H&M fell today to a 2-year low. The Swedish clothing chain reported a sudden slowdown in revenue due to the war in Ukraine, and earnings missed estimates. All that complicates H&M's efforts to clear out a 6-year inventory buildup. Global news 24 hours a day and on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Just as we've reached a critical turning point in this fight, Congress has to provide the funding America needs to continue to fight COVID-19. Americans are back to living their lives again. We can't surrender that now. Congress, please act. You have to act immediately. The consequences of inaction are severe.
The President of the United States from New York City this morning. Good morning. Futures unchanged on the S&P. On the Nasdaq 100, up by 0.2%. The yields coming in 3 basis points. We're down to 231.43 after rising through the first quarter, and particularly in the month of March on a 2-year yield, we've seen a massive move. Crude down a little more than 5%, fading from the lows of the session, 102.11 right now, Tom, as we wait to hear from the President a little bit later again today on the prospect of a reserve release. According to the team here at Bloomberg down in D.C., we could be seeing some big moves, maybe a little bit later.
Some of this tied in as well to the success of COVID. Christian Breyer joins us right now, professor and epidemiologist, Johns Hopkins Bloomberg School of Public Health. Of course, Mr. Bloomberg, a nodding acquaintance with his TV and radio network, providing to his alma mater. Dr. Breyer is, of course, expert on international, which means we must talk China. But first, sir, we must talk about the funding of an America that is approaching under 700 deaths. The statistic now is roughly 740. It is a triumph for people like you. Will this drift away at a certain point, or do we get the energy and the research effort forward that the president demands?
Well, we absolutely need that research funding. COVID is not done yet. As you all know, this quite infectious subvariant of Omicron, BA2, is having big impacts in Hong Kong and China, in many countries that went with zero COVID policies. And it does have some immune escape. So we really need to be looking at whether we need Omicron-specific boosting. Should we have a pan-coronavirus boost? And those are research questions. And the trials infrastructure that did this remarkable work on the vaccines through the NIH, its funding expires in November. So the president is absolutely right that the Congress has got to act.
Yeah.
We have to keep this research effort funded.
And John, to our conversation yesterday with Bhakti Ansari, this goes down to, guess what? The boosters don't end in November, do they?
No, and we might be getting more and more and more. And Doctor, I want to talk to you about that. And I think it's worth having a transparent, open conversations between you and I that maybe other people can benefit from. I'm a little bit concerned about having an extra vaccine. I'm on number 3. If someone turned around to me and said, have number 4, I'd be a little bit worried about what it would do. Can you talk to me about that now and tell me, if that becomes available, why you suggest that might be beneficial, not risky?
Yeah. So the data that we've used to make this decision are really from Israel. And the reason why the regulatory agencies went with a 4th dose, the second boost for people over age 50 with underlying conditions, is really because the Israeli data shows, first of all, that it is safe, and secondly, that there was a significant increase in protection, again, against serious disease, hospitalization, and deaths. So there's no question that for older people, the immunity does wane, and there's an indication for this. We need more data. Everybody is where you are in the sense that we're making this recommendation based on Israel because they're ahead of us in the vaccine effort, but there still is some uncertainty. It does look like the safety issues, particularly for people over 50, are not different between the 3rd and the 4th dose.
What about for the younger age groups, Doctor? When will we start to learn about that kind of thing? Because I think a lot of people worried, particularly in the younger cohort, young males, about heart inflammation, so-called myocarditis. What have we learned about that?
Yeah. So first of all, remember that COVID itself can produce serious heart disease and myocarditis. The rates of myocarditis in people who've been immunized, and specifically in younger men and adolescent boys, is definitely higher, and most of it has been relatively mild and transient. But there's more myocarditis for the unimmunized because COVID can do this as well. So on balance, it's still better to be immunized than not. I think that one of the big challenges we have is that only about 1/3 of Americans have had that 3rd dose, have had, or the boost after J&J. So the primary boosting is not going well enough, really, to protect against the next potential wave of BA2. So I think while we're encouraging people over 50 to get the 4th dose, we really need everybody else to get the 3rd.
Well, Dr. Beyer, especially as cases in New York City climb yet again, let's say, theoretically, somebody's had 3 shots and then they get Omicron. Are they protected from getting it again? How long does it take before that wanes?
Yeah, so natural immunity wanes more quickly than vaccine-induced immunity. We've seen that all along. And that's part of why some of the modelers are predicting that the U.S. may be vulnerable perhaps by June, because so many people who have not been immunized but have had COVID will have waning immunity. So that is a real concern. The scenario you're talking about, where somebody gets a bout of COVID, Omicron or BA2, after vaccination, many people and immunologists are perceiving that actually to function more like a boost. So, you know, the vaccines protect you from serious disease overwhelmingly. A boosted person with a breakthrough infection is very unlikely to have serious disease, but that would give you more immunity. The challenge there, of course, is that there are other people in many people's households, children under 5, not eligible yet, the elderly, people with immunocompromise. And so you still want to avoid COVID. And by the way, long COVID is turning out to be more of a problem, more common than we'd thought, and to have a health disparity. There's more long COVID in African Americans emerging. So that also is a real concern. And, the neurologic complications, the brain fog, the memory issues, we all really want to avoid.
Incredibly concerning. Doctor, thank you for an open conversation I think we've all benefited from. Chris Barrow there of the Johns Hopkins Bloomberg School of Public Health. Lisa, the kind of question I think a lot of people are asking themselves at the moment.
And frankly, this comes as we do see a resurgence in cases in places like New York. And does it matter if you don't see the hospitalizations? Does it matter if you don't see the deaths? Does it start to become another cold? When's that threshold? And what's the data going to show? And that's what Bhakti Hansadi was talking about with this latest wave.
Exactly what she said yesterday, Tom, that UK cases are picking up, but there is a disconnect between that and hospitalizations, and that's exactly what we wanted to see.
I would suggest as an amateur, and we've been really gifted with these guests that we've had, John, we're struggling with this strange word, endemic.
Yeah, I agree.
Where we have to live with it, and everybody every day, and particularly people with kids and with, old, fragile people, the new endemic is a new struggle.
The policymaker, Tom, moving away from it in a major way. Outside of Asia, of course, Hong Kong, China, but in Europe and here in the United States, there's a real effort to move away from this now, Tom.
Yeah, I mean, the debate the airline industry's having, masks on planes.
What do you make of that, TK?
You know where I stand.
Well, go on, tell us.
You guys are killing me today.
Where do you stand?
I think that there's a complete misunderstanding of aerosol and viruses, period.
He's counting down the clock. Did you notice that? That was good.
He's watching the
well
clock.
Done. Yeah.
He knows I've only got 5 seconds left.
What is this, like pre-April Fools or something?
Future's unchanged. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slowdown was inevitable. The question is, does the Fed hike so aggressively now that a recession hits?
We'd say we're highly confident that we can avoid recession the next 12 months.
Inflation rate now is at the level we've not seen in decades.
The downside risks are so great at the moment.
All in all, the economy is still in a decent place, and I think that means that we have room to move higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An eventful day. Yes, jobs data at 8:30 here in 30 minutes, John. Nobody's really focused on it. We're looking at oil, and we're looking at a continued war in Ukraine.
If first you don't succeed, try again, and then try again. The administration considering a monster reserve release, according to the team at Bloomberg down in Washington, Tom. Could be 1 million barrels a day, could be anything up to 180 million, could be announced today. We'll hear from the president a little bit later.
I mean, I look at when we hear from the president and we hear from the operation, the track record, John, on these efforts is sketchy, to say the least.
Not good, Tom. Gap lower, gap higher. That's been a story of the crude market. We've seen this movie a few times. Does size make a difference, Tom? Or do you just price this in further down the road? Ultimately, as you pointed out, Tom, you can't do this forever.
Yeah, a rude question of the week. Lisa Abramowitz, trophy taking by John Farrow, asking Greg Valliere about a one-term Biden. Valliere publishes today on a president speaking today on whether there's another term. That's how important some of these domestic decisions are.
And it's not an accident that you're talking about this with the oil reserve release, or the suspected one that we're going to hear about later today. How much does the price of oil determine whether Joe Biden, and frankly, not just Joe Biden, but the Democratic Party, will be able to eke out a win, not only in the midterms, which is probably off the table at this point, but longer term for another term of a presidency?
An important guest to get us started on Q2 here. We'll get to Andrew Sheets of Morgan Stanley in a moment. John, let's go through the data. I got red and green on the screen. I got a down negative, S&P positive, the VIX right sitting at 20 as well.
Let's do it on the session and do it on the month. On a session, we're positive about 0.05% on the S&P. On the month, we're up by more than 5%. On a session, yields are in 4 basis points at 230.88 on a 10-year Treasury. On a 2-year, that's where the price action has been. Your 2-year yield comes in 2 basis points to 228. But think about where we started the month. We closed out February in the low 140s. And Tom, we even had a look at the 240s on a US 2-year. It's been a massive move. Yeah. We've got pockets of inversion through the curve, and the spread between 2s and 10s right now is just 2 basis points.
John, I just noticed here, looking at the government Strategic Petroleum Reserve, the oil's in salt caves at 4 locations on the Gulf of Mexico. What do they actually do with it?
What do you mean, Tom?
When they release it, where does it go?
They sell it into the market, don't they?
I guess.
I assume that's how it works.
Maybe Mr. Draghi can do that.
Some of it ages as well, and you have to replace some of it too.
Yeah, I don't know. Engineering, petroleum engineering.
Ramo knows more about this than I do, and Javier Blas knows way more about this than I do.
I literally told him this morning, I am completely ignorant. Sweet, sour, crude, the refined, I need to do some research.
Javier, in the 9 o'clock hour, don't miss that conversation.
We are font of knowledge this morning. Let us save ourselves with Andrew Sheets, Chief Cross Asset Strategist at Morgan Stanley. And Andrew, what you do is you combine in so nicely all the fractious, and folks, I say this with immense respect, the fractious debate of Morgan Stanley, and your single phrase is solid growth. What does solid growth mean for my 2022?
Yeah, thanks. Good morning, Tom. Great to be here with you and everybody else. So solid growth to us means that growth is lower than where it was in 2021, but 2021 was a very high bar. That was extremely strong global growth. And 2022, we think, will still look pretty reasonable by the standards of the last 12 years, that we're still looking at, U.S. GDP growing around 4% this year. And even though we think we have a very disappointing first quarter in China, ultimately the full year growth we think will still be pretty reasonable, and that Chinese growth will reaccelerate as the year goes on. So when we're thinking about stagflation, I think we're thinking about a year much more like 2005, where PMIs are decelerating, inflation is higher, policy is tightening, than something where growth is really falling off right now in terms of what the market needs to deal with.
Andrew, the research you've put out recently is that we've priced in higher interest rates, but not the growth risks associated with it. Can you pour through the equity market for us and help us understand where you think that needs to be priced a little bit more?
Yeah, so I think this is where some of the debate around the yield curve, which I'm sure is something we are now going to be talking about for the next 6 months, is really interesting, because I think what the yield curve is discounting is higher odds of a growth slowdown next year, which we think is correct, and that certain asset classes are going to be more vulnerable to that than others. So, when we think about the overall equity market, when the yield curve inverts, it doesn't necessarily go down. In fact, it tends to keep rising after that inversion happens. The equity market's balancing, yes, there's some greater risk of recession, but there's also a possibility that things continue on for another 12, 18, 24 months. But assets that tend to be more growth sensitive, something like U.S. high yield, that tends to see a pretty bad risk reward when the curve inverts, when the odds of a recession are rising, and that starts to really underperform after yield curve inversion. So we think that favors somewhat more defensive positioning within U.S. equities, things like healthcare, utilities. We think that favors investment grade over high yield within U.S. credit, and then some of the non-U.S. developed markets we think could be in a better place, a marginally better place, because the financial conditions there are easier. Policy is under less pressure to tighten in Europe and Japan.
Andrew, I find the banks call fascinating at the moment. Betsy Graseck made a move early this week. Can you walk me through how you and the team are thinking about the financials?
Yeah, so we downgraded financials from overweight, which had been a favored sector for a while, down to equal weight. And the reason for that is a function of both. We've had a very large interest rate move that had helped the sector, but also financials, as you start to get later in the cycle, have to balance both loan growth that is often still strong. Banks continue to lend even after the yield curve flattens, with the market often thinking, well, if the odds of a recession are rising, we need to price in a higher risk premium around higher loan losses 18, 24 months out. So we think the sector's risk reward is now a lot more balanced here. Again, as those two factors are competing against each other, and after we've had a pretty large rate move, and so that leaves us more balanced and looking to reassess.
Andrew, where do long bonds sit in your portfolio, given the sell-off that we've seen to date, and given the call that you have that we're in the same kind of environment longer term, even given this blip?
So I think that the backdrop favors a flatter and more inverted curve. That's very much the way that our interest rate strategists at Morgan Stanley are thinking about that, and that we could even have a dynamic where the 2-year rate continues to go up towards 3%, but the 30-year bond does not rise in yield from here. Maybe it even declines a couple of basis points. Again, as the market is looking at a very strong, we think, structural demand for longer term duration, and also as overall yields rise, the funding position of pension funds gets better. That increases the desire to buy long duration assets to defease those pension liabilities. So we think longer term investment grade bonds offer better value here than, say, high yield. We think some parts of the emerging market credit index will offer better value than, say, emerging market equities here, again, in part thanks to the longer duration of that index. And we certainly would put ourselves in the curve flattening, long end outperforming camp.
Andrew, I know you've been building cash, and that Morgan Stanley's approach generally has been to hold a bigger portfolio of liquid assets. At what point, what signals are you looking for to shift that, to deploy more and to go more into risk?
Yeah, it's a great question. So one, I mean, the equity market has clearly rallied back very, very quickly and more quickly than we expected. So, certainly lower prices, but more specifically, a higher equity risk premium would be helpful. What we've seen is, in our measures, a real compression of the equity risk premium, a large richening of equities relative to bonds in a short period of time. I think more space opening up there would be helpful. I do think the investment case in Europe could be a lot cleaner if we saw somewhat more certainty around the direction of the conflict in Ukraine, and that could I think certainly improve the risk reward as we think about that market. But I do think at some level the die is cast. We do think we're in a later cycle environment. A flattening yield curve, low unemployment, tightening policy is a part of that, and I think that at a broad level is naturally going to constrain how much risk we think investors should take, kind of regardless of these other factors. So, we think this later cycle environment is often one where one wants to be closer to home in their portfolio allocation, but, we would be looking for greater risk premiums to emerge in equities credit that we think would compensate for those risks before redeploying cash.
Andrew, just quickly, how's London? How are things right now? Because when I call family, they talk to me about how much everything costs at the moment. They tell me house prices are through the roof. What are you experiencing in the general economy there? What does Europe actually look like from your experience in the UK at the moment?
So, what we talk a lot about stagflation. I think the stagflation story varies a lot where you talk about it, right? You have very low inflation in Japan. You actually have quite good growth still in the U.S. I think the UK is closest to that stagflationary outcome. Growth here is weak and make it weaker as you see very large cost of living increases bite, even starting next month as utility bills rise. At the same time that inflation is still very high and where the current account deficit is still large. And so I think the Bank of England has a real challenge to it. I think on a structural basis, we are thinking that the pound will weaken against the U.S. dollar, the Canadian dollar. And I think the UK does face a tougher macroeconomic backdrop than the European Union or the U.S.
Andrew Sheets, awesome, as always, of Morgan Stanley. Thank you, sir. On crude, OPEC Plus, just wrapping things up. 432,000 barrel a day supply increase scheduled for May, in line with expectations. Here's the line for you, Tom. Here's the quote. OPEC Plus hurried through its last meeting in just 13 minutes without discussing the issue that was dominating global commodities markets. It beat that record by a minute at Thursday's talks, according to a delegate. How are you meant to take these guys seriously right now, if that's how long they meet for?
John, we need team coverage on this, a road trip to Vienna to get the full story.
From New York.
Obviously.
This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Biden administration is weighing a massive release of oil from U.S. reserves to fight inflation. Bloomberg's learned 1 million barrels of oil a day may be released for months for up to 180 million barrels. President Biden is set to speak today on efforts to reduce energy prices. Meanwhile, OPEC and its allies are refusing to engage with the energy crisis triggered by the war in Ukraine. At its meeting today, the OPEC Plus coalition is expected to stick to its schedule of gradual oil output increases. That plan was reached last July and has been followed ever since. Saudi Arabia has prioritized relationships with Russia, which co-leads the OPEC Plus alliance. Vladimir Putin is offering to compromise on his demand that customers pay for natural gas in rubles. That's according to Germany and Italy. Italian Prime Minister Mario Draghi says the Russian leader told him current contracts could stay in place and the conversion to rubles would be done in Russia. Some of Europe's biggest airlines are renewing their call for more government aid and legislation to help the industry decarbonize. The CEOs of Lufthansa, British Airways owner IAG, EasyJet, and Ryanair gathered today in Brussels. They argue that money is needed as airlines make the costly transition to cleaner energy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, it's really important that the jobs recovery continues.
The March Jobs Report, Friday on Bloomberg Television and Radio.
Longer run, and I don't mean years, I mean a month or so, I think the oil markets will basically recover in terms of supply side.
Ernest Moniz there, the former U.S. Energy Secretary from New York City this morning. Good morning. Futures unchanged on the S&P. The final trading day of Q1 2022. Futures up a third of 1% on the Nasdaq 100. Yields in, down lower, -3 basis points on a 10-year to 231.97. And crude, a whole lot softer. We are lower by more than 6% to 101.30. With our reporting, Tom, driving crude lower. The Bloomberg team pointing out that the Biden team is weighing a massive reserve release of crude to combat what's happening at the pump.
And one of those sites of the four salt mines, if you will, the salt caverns, John, is scenic West Hackberry, is where we'll get those millions of barrels or whatever we're doing. And that is about the Strategic Petroleum Reserve, and it is something that will affect the global price of oil. We are advantaged with all of our coverage founded by Stuart Wallace, Javier Blas, and the rest on hydrocarbons. And we get expert view today from KPMG, their global head of energy, Regina Mayer. Regina, I've got to rip up the script here and take it from the Strategic Petroleum Reserve to your visit in recent days to the United Arab Emirates. We spoke to the head of their energy policy who stayed on script. I need you to get off script. What is the power of the Persian Gulf to affect global price and diminish Mr. Biden's efforts to lower price?
The OPEC plus producing nations definitely have the power to lower prices right now. I was struck by that, the confirmation that there is spare capacity in both Saudi and the UAE. But there is a sticking to the script that all of them are focused on. They have an agreement. That agreement has been in place, and they are sticking to the agreement. And then I think that gives a little bit of a buffer from some of the external pressures that might be facing them. And then when you ask each of them independently, right, so the UAE will say, well, we're just 10%, right, and there is an agreement. So I was not surprised by what came out of today's 12-minute meeting.
Take us from Doha to a Bloomberg surveillance conversation with the Secretary of Energy a number of months ago, and the point of the argument was the one price of oil. Is that true that Mr. Biden and the four salt caverns have to deal with a global oil price, or can they manage a U.S. price?
Well, I think that the challenge for the U.S. administration is that gasoline prices more closely correlate to the global oil price, which is tied more to Brent versus WTI. So while we do have abundant U.S. supply, which we still have a challenge of getting out of the ground, labor shortages, costs, et cetera. But the price of gasoline pivots more closely with the price of Brent, and that's where OPEC Plus and some of the other suppliers come into play.
Regina, we're looking at this oil reserve release, potentially, as reported by Bloomberg, that could amount to 180 million barrels in sum after all of the months are added up. How much does this actually reduce the strength of the U.S., basically diminishing the reserves and actually propping up prices even further later when they try to rebuild them?
Great question, but if you believe some of the other analysts, like Secretary Muniz that was referenced earlier, there is a belief that toward the end of the year, supply markets will balance. So if there's an opportunity to diminish some of OPEC's influence in the short term and ease prices at the pump for consumers, then that's the wise decision to take right now. I worry less about what it does to our defense ability in the future and the cost exposure, because I do think oil markets are poised to settle down in 2022, 2023.
Regina, to double down on that point that Ernest Muniz and you echo that we're going to have more of a balancing in the rest of the year. What does that assume? The end of what's going on in Eastern Europe, the bringing back on some of the Russian barrels, or other sources as production increases in the U.S.?
All of the above, plus I think the one thing, Lisa, that maybe you left out is that the current price is an incentive to non-OPEC producers. So a lot of plays are in the money, and I think people will do what they absolutely possibly can to bring more of those supplies to the market so they can monetize. Think Canadian oil sands, think investments in Mexico. So there are other sources of supply, Guyana and the find that we have there, that I do believe will come into the market, and that's what folks are counting on to help ease the supply crunch.
Regina, can you just clarify something for me quickly? What is the SPR for? And is this the right way to use it?
Well, I actually don't feel qualified to comment on that, Jonathan, because I think it's a lot about our defense of our country. Fuel is a really important commodity. I grew up in Hawaii, and I remember the 70s sitting in the backseat of my parents' car for hours on end on an odd or even license day, waiting to be able to fuel up our tank of gas, so that we could drive around a small island. So I think that's what it's intended to try to buffer, and that we could, gosh forbid, that there would be a large conflict. We have those supplies, and I think it's pretty important.
Regina Mayer, thank you, of KPMG. TK, that's an important conversation at a moment like this. Is it to manage price, or is it for a real supply scare when we really, really need it? Is this the right time to be using it?
Paul Sankey would be one to talk to on this, and Amrita Sen, I'm sorry, she's lights out, John. It's about the microeconomics of supply, demand, and the way it lines up. On radio, I'm crossing my hands like the Marshallian cross. It's different in oil, John. They vibrate in that gap. That determinant of that cross is tiny, tiny. It's a very sophisticated phrase I learned from Javier Blas. It's teensweens.
Crude down a little more than 5%. You'll hear from the president later.
Okay.
You nailed it. If he takes some questions, I'm sure some people will ask him about that. Mike McKee's in the studio. That means one thing. In about 5 minutes, you get some economic data. Tom, we haven't talked about it all morning. Lisa mentioned it. Jobless claims, 196,000 is the median estimate going into claims this morning. That number, Tom, staggeringly low. Just phenomenal. Sub 200K expected again.
And population adjusted, it is a cultural statement, a social statement. I'm not really sure what it means, John, but that, I don't have the chart in front of me here, but the population adjusted chart over 30, 40 years is stunning.
Even if you don't population adjust that data point, Lisa.
It's stunning, yeah.
187 is the lowest we've seen going back to the 60s. 187K was the last read. 196 is what people are looking for this morning.
A lot of people, though, asking about the participation rate. How many people have simply dropped out? How many more people could get back into the market? How much is that number representative of the overall pool of that population growth?
Mike McKee's going to break down the data for you in just a moment. 490K is your payrolls estimate so far. That's a moving target into tomorrow. That's the latest median estimate in our survey. 490,000 for payrolls in America. Jobless claims is up next. Futures positive 0.1%. Yields lower by 3 basis points. And crude down more than 6%. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
McKee just gave me a slap in a commercial break and said it's not about jobless claims, John, it's about the PCE.
He's so
PCE
rude.
data.
You know, John, they don't know the real McKee.
Just shaking it off. Futures unchanged on the S&P, on the Nasdaq 100, up a third of 1%. The Academy are going to ask him to leave, Tom. He's going to stay.
Really? Oh, you have no
Yields
idea.
are down 3 basis
Bloomberg
points.
Academy.
2.32. Crude is down around about 6%.
Thank God we're waiting for the data.
I'm still
here.
waiting for this
17
economic
seconds
data to
in.
drop. Please drop.
Put us out of our misery.
Mike McKee, good morning to you, sir.
Well, the internet is slow today for whatever reason, and we are waiting for the numbers the way we get it these
We're
days.
breaking as we
And
wait
it
for
does take.
breaking
It does
There we
take
go,
a
Mike.
while.
There we go.
We're just starting to get in the numbers. Jobless claims jumped back over 200,000 to 202,000. Remember last week came in initially at 187, and that is not really a surprise. A lot of people thought jobless claims were sort of overdone last week. The 187 was revised up to 188. So we're still extremely low, as you said earlier. Okay, the PCE numbers that we really wanted to see. The deflator on a month-over-month basis up 0.6. That's what was forecast, and it's the same as last month. And so it pushes the year-over-year deflator, the PCE index that the Fed follows, to 6.4% from 6.1%, bang on with estimates. But it does show that the inflation problem continues for Jay Powell and company. Americans made more money. The personal incomes were up 0.5% after no change last month, and spending up 0.2% after a 2.1% gain the month before. So it does look like maybe we made a little bit more money, but we held on to it. That's going to be the question, is how fast does the economy slow down in the face of higher interest rates? Even if Americans have more money, a lot of predictions are that we would be spending down the savings rate. And at this point, doesn't seem to be, it could be what's happening, but as long as people are replacing their income, they'll still have the capability of getting out there and spending.
Mike, I'll just run through the price action quickly on the equity market. We're up about 0.1%. No big change here on the Nasdaq 100, up around about 1/3 of 1%, up 0.4%. Yields were lower going into the data, still lower now on a 10-year. We're down around about 4 basis points to 231. And crude was softer too going into all of this because of our story about potentially a monster crude reserve release from the administration and maybe announced later today. 2s10s, Tom. 2 basis points. 2 or 3 basis points
Yeah,
this
that's
morning.
exactly where I wanted to go, John. Really further curve flattening here, getting down near that inversion point. Mike McKee, one observation here off GDP and combining it with the jobs report tomorrow, and I guess a fully employed America. Nominal GDP was 14% in the fourth quarter. Atlanta GDP for this quarter ending is 1-ish%. Do you take 1% plus the 5% you just reported and say nominal GDP has gone from 14 down to 6% in this present quarter?
It could be. This is the Omicron effect. We've forgotten all about the pandemic and Omicron, and it really slowed growth in the first couple months of this quarter. So at this point, that's kind of getting looked beyond by analysts because they're saying, you know, that's the effect. We want to see what happens this month. The month of March, and we just got the February numbers, so we have a ways to go.
Are you with us tomorrow?
I'm with you tomorrow from Washington, D.C.
Very good. Michael McKee in Washington for the important jobs report. Very nice.
Are we doing that lockup again, Mike? Is that back?
No, they're not doing the lockup.
No, he's
just going there to go
I
there.
just figured it's a way to get an expense account trip to Washington. You know, it's like Tom does.
You know, McKee with the St. Regis
Borrow the
Barnum all night. Look for that.
Surveillance jet.
I'll
head down there.
Yeah, we'll do that. I don't know who has a jet this weekend. Neela Richardson joins us right now, chief economist at ADP. That was important, of course, with their Wednesday effort on ADP statistics on the American labor economy. Neela, let me start with Richardson 101. Are we a fully employed America?
No. We can't be as long as 1 million workers are still on the sidelines and, you know, the labor force participation rate is below pre-pandemic levels. But that goal is moving. What is full employment with a smaller workforce? It is defined as the level of employment, the largest number of employed people the economy can support without spurring additional inflation. And so that's going to be a moving goal as inflation hopefully comes down over the course of the year.
Neela, I was parsing through the data, and frankly, the most interesting aspect of this was real personal spending, which was down by 0.4% negative. We're looking at negative numbers. People are not spending as much as inflation is going up. Is this a signal or simply a blip?
Well, you can't answer that in one yes or no, because consumers are very bifurcated. Low-income consumers spend what they have. So that little increase in personal income, if it was 2 low-income households, that's actually a good sign for spending going forward. High-income households spend when they feel confident about the economy. And there is indication that consumers are not confident with inflation this high. So it's a mixed picture right now in terms of where that increase in income landed. If it landed with the low income, they need that money to keep up with rising fuel and food prices. And you might see that translated into consumer spending.
If the Fed were looking at this data, do they get comfort from seeing a decline in real spending? In some ways, do they want to see a deceleration in demand?
They want to see a deceleration in inflation, not so much a deceleration in demand. Unfortunately, you can't have one without the other. They want to see an economy that continues to grow. So I think that they're very careful of where the demand is being contracted, right? They'd like to see it in house prices and rents, not necessarily, though, in incomes and wages. But that is going to be the challenge, that they have this very blunt instrument. They can't control where the demand contracts in the economy.
Neela, you have a huge advantage no one talks about. You go into the secret combine of ADP and you calculate all the payrolls and all the corporations using ADP for that core automatic data processing services. What are corporations doing right now? Consumers, 70% of the economy. I'll let you tell me what corporations are, 11, maybe it's 15% of the economy. What does ADP and you see is the doing, the action of corporations right now?
They're trying to figure out how to hold on to their people. We have a very low jobless claims number. It's not as low as it was last week, but it's awfully low. And you pointed to what the cultural notion of this is. The cultural notion in terms of the business climate is they are very reluctant to let go of people because they don't know if those people are going to come back. We have a very high quit rate that is elevated. Job openings are hovering near record highs, and hirings are not keeping up with openings. So right now, everyone is very focused, big clients, small clients, on retaining their people and hiring in a highly competitive environment for talent.
When we're talking about the corporate outlook, Neela, let's end where we began this show, which is really on Restoration Hardware and this call that they had, where they basically threw the kitchen sink at their expectation that growth would decelerate and that their business outlook would deteriorate. How much is that representative of the larger corporate universe in face of the inflation and the consumer where they are versus perhaps a more specific or ambiguous story?
Look, as the economy, as this recovery matures, what we expect is a shift in consumer spending from durables, like furniture, over to services. That's what we're waiting for. The problem is that service increase is capped by employees. If services can't find the headcount, especially in leisure and hospitality that took a large hit from the pandemic, then we are not going to see the growth. So it is a macro story in terms of durable goods like furniture, like more big ticket items, but it also is about this transformation of the economy through the recovery back into services.
Neela, always an education. Thanks for being with us. Neela Richardson there of ADP. A big couple of weeks coming up. In 2 weeks' time, on April 12th, you get CPI data for the month of March in America. The day after earnings season, the unofficial start with JP Morgan numbers, Tom. So 2 weeks away. Some important days coming up.
And what we've heard from people, including Julian Emanuel with an optimistic view with Evercore ISI, is, revenues, earnings, but they're going to look at those ratios, those margins down the income statement is a real determinant forward.
President Zelensky speaking at the moment, Tom. That European tour of parliaments continues. It's the Belgian parliament this time around, seeking new sanctions and a path to EU membership. Let's talk about the former, not the latter, Tom. New sanctions. What else is left?
I would talk to Boris Johnson. Am I right, John, that the UK has led the way on this? They seem to be
on individuals,
the most strident.
Tom?
Yeah.
Sure, I think London and the city is more exposed to that anyway, TK, so that's why there was this pressure there for the Prime Minister to do something more on that front, the Europeans as well. You've mentioned that a few times. I think you're right.
No, I just think that it's movable and fluid and no one knows where this is going. And I'll be honest, John, I'm looking more at the war news, which, you look at the live feeds and all the different newspapers, including Bloomberg's wonderful work, and you want to know what the Russian troops are doing. And John, to me, the hallmark on a Thursday of this week is the silence from along the Black Sea.
Yeah, and Tom, I think we're all thinking of the disconnect at the moment between the words we see in the headlines that shape these markets and the actions on the ground. And this week, no different to what we saw play out a number of weeks ago on the same thing. You hope for a diplomatic breakthrough. It looked like we might have one. Constructive tone from both sides coming out of talks in Turkey. And then what you see turning out on the ground, Tom, the action is just so different. Jens Stoltenberg backing that up this morning, the NATO Secretary General.
Well, it's not that it evaporated instantly, but, and I'll say this, John, I know we don't have time here to dive into it. What I'm stunned by is the openness of Western intelligence here, led by the head of the Secret Service of the United Kingdom yesterday.
20 minutes away, we'll be talking about this crude move. Oil lower by 5.5%. We'll do that with Brian Nick, the chief investment strategist, coming up a little bit later from Nuveen. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration may use the nation's strategic oil reserve to help fight inflation. Bloomberg has learned that the U.S. may release roughly 1 million barrels of oil per day for months to combat rising gasoline prices. The total release could be as much as 180 million barrels. President Biden is set to speak today on efforts on energy costs. Ukraine says talks with Russia are set to resume on Friday. The negotiations will take place via video conference. In-person talks in Turkey this week did not produce a ceasefire or major progress toward a broader peace deal. Russia did agree to reduce military activity in northern Ukraine. Barclays is the latest bank to raise compensation for its lowest paid U.S. workers. They'll get a 21% pay hike from $17 an hour to $20.50. It applies to more than 900 employees, primarily at Barclays Consumer Bank. Toyota will be likely the #1 automaker in the U.S. for the second quarter in a row. Now, that will become clearer tomorrow when most major automakers report first quarter sales numbers. Toyota offers 18 hybrid and fuel cell models, a big plus at a time of rising gas prices. Shares of H&M fell today on a 2-year low. The Swedish clothing chain reported a sudden slowdown in revenue growth due to the war in Ukraine, and earnings missed estimates. All that complicates H&M's efforts to clear out a 6-year inventory buildup. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Russia has repeatedly lied about its intentions. So we can only judge Russia on its actions, not on its words. Russian units are not withdrawing, but repositioning. Russia is trying to regroup, resupply, and reinforce its offensive in the Donbas region.
A gentleman from Norway with NATO, Jens Stoltenberg, and he will not leave NATO and go back to Norway to run the central bank. He will stay at NATO for a further tour of duty. At 8:48 on an eventful Thursday, Jobs Day tomorrow, there are 14 stories to cover right now. But Lisa, the news intrudes. It's a single headline from Reuters with a little bit of Bloomberg first word follow-up. Russia payment on a dollar bond out 8 years processed by JP Morgan. And Lisa, I guess we assume it was processed in US dollars.
They probably, well, we don't want to make assumptions. That's been the big question, I will say. And what, just to give some context to this, it was a $447 million coupon payment that was due. We have heard certain bondholders have received previous payments for other coupons that were due. What's interesting to me is this week's call by Russia that they would offer to buy back some of their debt, their dollar-denominated debt, in rubles. How are they going to try to play with this without defaulting?
The romance of spring in Europe, Lisa. We now turn to our Maria Tadeo. It is an icy 50 degrees in the rain in an election-driven Budapest, and she joins us now with snow scheduled for the Sunday election. Is the nation gripped, Maria Tadeo, by this election, given war on an 80-mile border 4 hours east of Budapest?
Yeah, Tom, it has been overshadowed by the war. If you remember at the start of this campaign, Viktor Orban, who of course is running for re-election on Sunday, he wanted to make this about, well, the issues that he likes, that he feels comfortable with, family values, traditional family values in this country. Now it's completely shifted to Ukraine, and the way that this election is now being framed is this is war, or you vote for Orban and you stay neutral and peace. Of course, when you talk to his rivals, they tell you ultimately what's happening here is that he's a puppet of Vladimir Putin, and he has destroyed a lot of our credibility in foreign policy, but also our good relations with our neighbors, including Poland.
Maria, as you well know, the zeitgeist overnight was reporting, including GCHQ, the espionage units of the United Kingdom, of a Mr. Putin not being informed by his military staff, et cetera, et cetera. I mean, you know the drill here. What veracity do you give to this? How in the dark is Mr. Putin?
Well, Tom, at this point, it's very difficult to know or even understand what he thinks and feels because we barely hear from him. And everything, of course, is doctored in such a way that it wants to send a political message to the Russian audience. And that's it. We haven't really seen a lot of Putin lately. But that, of course, matches what the intelligence of the United States has put forward. It matches what NATO says. And, of course, now the UK also saying there is a real problem about the information that is being fed to Vladimir Putin. The other thing I would point to is Zelensky. He gave an interview to Russian journalists a few days ago, and he said, I am 99% sure that he only went in on Ukraine because he was given the wrong info. He was told the whole of Ukraine is Crimea 2.0. They hate Zelensky. They will want a new government. All of this was false information. And by the way, Tom, just very briefly, the boss of the military intelligence in France has been fired today because of the botched and the flawed intelligence that the French had before the invasion. Remember, the French said that they did not see this invasion happening.
Maria, we have the call also from Volodymyr Zelensky of Ukraine for additional sanctions. What could potentially be on the table?
Well, we've talked about the energy situation for weeks now, but I think by now it's very clear that the European Union is not willing to go there unless we see major escalation. And of course, it's terrible to say this, but that would be chemical weapons used on the ground in Ukraine for the time being. And I spoke with the German finance minister earlier this week. They just want to see the full impact of this. And there's a little bit of fatigue to this kicking in, but also a number of governments that tell you we can't be in a position where our own sanctions will penalize our economies more than we do with Russia. So at this point, if you ask me, are we going to see anything significant this week? I would say probably no.
Maria Tadeo, thank you so much. Greatly, greatly appreciate it this morning with her coverage through the weekend of this important Eastern European election. Lisa, it is time to once again look at what I think is space flight, but is certainly this time around celebrity-free tourism. The fourth launch of Blue Origin is different this time. There are not former star players of the New York Giants. Mr. Bezos has other things to do, but there's a set of I guess, tourists, Lisa. That's where we're now to where I think Jeff Bezos wanted this to be.
Well, and just to be clear, it wasn't for lack of trying. I think Pete Davidson of Saturday Night Live was supposed to be on this flight, but pulled out at the last minute.
Who's Pete Davidson?
You seriously? Have you never watched Saturday Night Live? Okay, we don't have to go there. I will say, though, that there is this question about space tourism and also how the intersection of national space programs works with space tourism as we enter a new era of exploration of, frankly, discovery on many levels.
And you compare it with what we observed yesterday in Kazakhstan with the return of the Russian and United States astronauts from what I'm going to call the space station. I don't have the official name in front of me, but both landing terrestrially. We're going to do this in Van Horn, Texas. John Farrell will have complete team coverage of this with Ed Ludlow coming up here on Bloomberg Television, and we will drive forward a space flight on radio as well. John is steeled for this.
Tom, you haven't asked about a road trip to space. Is that something you'd ever want?
I'll be honest, I haven't even thought about it, but I really question as they go up here to near space if this is space. I would defer to the old school
And
crew.
there you've got it.
Are they
Existential Thursday.
Are they doing their inner John Glenn here, or is it something different? But with great respect, it's very cool that mere mortals are going up there and not grizzled, experienced military officers?
Well, we shall see. I will say I'm really trained on markets. I'm trained on oil markets today. I want to understand how long this drop in oil can actually be sustained.
If I watch Martian this weekend, does that count as my space flight?
I don't know. It depends what your company is.
Jobs Day tomorrow for us. We are steeled for it. Coming up, space coverage with John Farrow. We'll do it on radio as well. This is Bloomberg. Good morning.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Jamie Maggio. The women's semifinal lineup is set after Wednesday's action at the Masters 1000 event. Newly minted world number one Iga Swiatek is just 2 wins away from completing the Sunshine Double after she took out Petra Kvitova to reach the semifinals. The Polish star is now unbeaten in 15 matches after victories in Doha and Indian Wells.
Well, having that kind of streak got pretty tricky, but I'm pretty glad that I can play well and that I'm healthy and, that I can compete against players like Petra because, she's a legend.
She'll face American Jessica Pegula in the Final Four after Paula Badosa retired due to a viral illness early in the first set of their quarterfinal. The American beat Swiatek in their only previous meeting 2 years ago. And don't forget, Tennis Channel's live coverage continues at 12:30 p.m. Eastern. I'm Jamie Maggio.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Closing out Q1 2022, and what a quarter it's been. From New York City this morning, good morning, good morning. Futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, discussing new sanctions on Russia.
We are continuing to look at options to expand and deepen our sanctions, and I anticipate that we would probably have more for you on that in the coming days.
Ramping up the pressure abroad and looking to alleviate the pressure at home. Bloomberg reporting the White House is considering a massive release of crude from its reserves to combat inflation and surging gasoline prices. Crude trading sharply lower on the news. Investors now looking ahead to 1:30 Eastern Time, with President Biden preparing to deliver remarks detailing his administration's plans on how to address energy prices. Team coverage starts right now with Bloomberg's Maria Tadeo from Budapest and Emily Wilkins down in D.C. So, Emily, let's start with you. This Bloomberg story rocking this market, for crude at least, this morning. Run us through the details.
So we're expecting to hear from the Biden administration to announce today that they're going to start releasing roughly 1 million barrels of oil a day from U.S. strategic reserves. Now, we've seen other releases in the last year, but this one's expected to be much bigger, potentially 180 million barrels of oil when all is said and done. This is really directed as gas prices have continued to gone up. The Biden administration initially expected them to go down this year. That hasn't happened, and now Americans are facing pressure at the pump, and Democrats are also facing pressure to really address this key issue as Americans are struggling with inflation, and they face an election that is not expected to go their way this November.
Maria, that's the United States. Europe, as you know, has its own problems.
Yeah, it does. And Jonathan, when it comes to the sanctions, are we going to see anything that tackles the energy market? That very, very reliant relationship between Russia and, of course, the European Union, we're probably not going to see it. I think, if anything, the debate here is not do we ban it or veto it or not use Russian gas this winter. The question is, how do we pay it? That is a real debate happening in Europe. And today we heard from the Italian Prime Minister, Mario Draghi, very clearly signaling that he had a conversation with Vladimir Putin. And in that conversation, the Russian president repeated the European companies would be able to pay in euros. There would be no need to pay in rubles. That was the initial demand. It does seem that the Russians are backing away from that. And again, another warning from the Europeans that anything that looks like breach of sanctions and breach of contract would be incredibly problematic for them.
Maria, Emily just went over the political pressure from the electorate the administration was under, the president specifically, ahead of the midterms. In Europe, there are a series of elections starting this weekend, France included, and where you are. Run us through the kind of pressure they're under.
Well, we have the Hungarian elections happening here. Of course, there's Viktor Orban, who's running now for a 4th term. Now, this was an election that was supposed to be very political, about family values, Christian values, defending Hungary for the Hungarian people. But of course, the war in Ukraine has overshadowed all of this. And if anything, what you see now is that Orban, he is polling well, because he says we're not going to veto Russian energy. We are not going to go for super strong sanctions either, because we need to watch out for our own economy. Our interest is to protect our economy. It's not the Ukrainian people that I have a duty with, which of course is a very blunt message, but essentially that is the gist of this campaign. When you look at the French election that's happening next week, of course, and then you have the final result in the final week of April, it is complicated for Emmanuel Macron. We are seeing that bills are rocketing across Europe. We see it everywhere, and every day we see finance ministers, one right after the other, hinting and saying we're going to need more measures to try to calm down inflation. At this point, it is a very real problem away from all of the political issues that we're facing. This is just a spending problem for Europeans that are definitely seeing their bills are all going up.
Maria, thank you. Maria Tadeo and Emily Wilkins on the political situation and the prospect of a monster reserve release from this administration maybe later today. We could be seeing anything up to 180 million barrels of oil released, and crude is down around about 5 or 6% through much of this morning. Joining us now to discuss is BlackRock's Jim Keenan, Nuveen's Brian Nick, and Julie Beale of Kane Anderson Rudnick. Julie, first to you. This quarter has been amazing, and at times amazing for all the wrong reasons. Talk to me about how energy and the moves in crude this quarter alone has changed your view, perhaps, on the year ahead.
Well, I think it's now made it much more difficult for things to work out for the Fed in terms of architecting a soft landing. And I think now they're been to a much smaller corner in terms of being able to execute a more gradual position. We now are talking clearly about 50 basis increases. If you asked me in January if that were possible, I would have said no, because I think Powell was really behind the curve on it. But now he's regularly talking about 50 basis point increases. And the White House, too, is well aware that becoming an increasingly difficult position for a Democrat. It's very hard, really, for administration to do much on inflation. And so it's having to these big, bold shares, like releasing reserves. I think it's going to have a huge impact on oil prices. It does really impact the politics.
Julie, just a little bit of a technical connection problem with the audio. We're going to try and re-establish that. Jim Keenan, I know you wanted to jump in, so you can now, sir. Your thoughts?
Yeah, I would say I wouldn't necessarily use the word amazing. I would say highly complex. I mean, if you think about how we ended last year, we already started to see a tight labor market. The energy markets, were rebounding dramatically just with regards to the restart of the economy and the demand side of the equation. When you think about what's gone on over the last month, we've exaggerated or accelerated some of the trends that have gone in, and so the energy market in general is incredibly tight relative to the underinvestment that we've seen for the last 5 or 6 years. And you have an environment where there is, I would call it, more discipline with regards to bringing on supply. And it's also difficult to bring on supply because of, the labor issues, the scarcity of some of the resource and materials needed to kind of to really get the oil markets and the gas markets up. So I think that pushes the Fed into a much more complex scenario with regards to the pressures that they're seeing on inflation. And their limitations on how they're going to be able to ease that. And so certainly, I think you're going to see the Fed, hold to this hawkish tone. You're seeing the consumer sentiment come down pretty quickly just with regards to the uncertainty of the tax that they're feeling. And I think that's going to create a lot of volatility in the overall market. I don't necessarily think it changes the long term, but this transition from where we were in the last couple of years in the restart to transition to a more normalized economy coming out of all the complexities of the pandemic and the supply chain issues is going to have a lot of volatility around the overall economy and the corresponding policy.
That transition has come with higher prices. Brian, Nick, just to give you the opportunity to respond to the story we've started with this morning. We've seen this movie a few times over the last 6 months. They have a crude reserve release, crude gaps lower, then it gaps higher again. We've seen it a couple of times. Any reason to believe the plan that we've outlined in our story this morning wouldn't just end up in the same place, with crude gapping lower a little bit and then back to where you were before?
No, in fact, I think you were right to focus on the political dimension here. I think there's clearly a political imperative with the elections coming up in November to seen as doing something to try to get prices back down. But I think absent a durable, sustainable increase in supply or some resolution to the conflict that results in lowering sanctions, you're not going to see a fall in the oil price to the levels that we saw in the beginning of February, which are already elevated. And I don't see either one of those things happening. What this has done is thrown a lot of confusion, I think, into the economic outlook and specifically into the job that policymakers have ahead of them, because what this does is effectively act as a tax on consumers. I mean, imagine seeing a 1 month increase in German inflation of 2.5%. There were entire years where they didn't hit 2.5% on an annualized basis, and now we're seeing it in 1 month. So that makes it extremely difficult for policymakers to know what to do, because if this is effectively a consumption tax and will detract from other things that people normally spend their money on, then it's not clear that the right move is to raise interest rates, unless you see inflation expectations also becoming entrenched at much higher levels. And in that case, the Fed maybe, and the ECB as well, may think they have to respond to this with higher rates. So it does throw a lot of confusion into what was already a pretty complex
Things have changed so much. And Jim Keenan, to Brian's point, if this plays out in Europe, as some people think, we face the prospect of interest rates going back through zero. Now, I know that sounds ridiculous, but 2014 was the first time they went into negative territory over at the ECB. They've stayed there for 8 years. Now, Jim, I wonder how that would transform global fixed income if you could have a positive nominal rate out of the ECB, how it would transform the European bond market and what it would mean for that matter for treasuries and for credit too.
Yeah, and it goes back to the point with regards to complexity. I mean, the economy is coming out of a pandemic, and this restart, obviously, for the last 12 months, coming into this year, I think there was a lot of certainty in the overall market. There was certainty with regards to the speed of the recovery. As you enter this next phase here in this regime, there is a lot of complexity, and I think there's going to be a lot of inequality with regards to what that means with different regions, but also with regards to sectors. And specific to Europe, obviously they're more exposed to the issues of the Ukrainian-Russian conflict and what that means for gas prices there. So the inflationary pressures that they're feeling, the health of the consumers in a different spot than the United States. And so I think that's a pretty acute issue right now in the short term with regards to the potential with regard, even a recessionary risk in the next kind of 12 to 24 months. I think long term, we're all still going to deal with, as we come through this, we still have to deal with significant aggregate debt burdens that now sit on government balance sheets. And, so those I think are going to be headwinds to longer term growth and keep the long end of the curve, I would say, fairly anchored within the range. And so I do think you're starting to see, you've seen it already with regards to the flatness of the yield curves globally, and even some inversion because of those longer term issues as we have to deal with.
Jim Keenan, sticking with us alongside Brian Nick. We'll re-establish that connection with Judy Bill. She'll be back in just a moment. Some stocks on the move ahead of the opening bell, 20 minutes away. Here's Abby.
John, well, sticking with this lead story that you all are discussing, or the idea that the Biden administration is weighing the possibility of a big daily release from U.S. reserves. Not surprisingly, oil down, as you know, down around $102 per barrel for WTI crude. The energy complex really getting hit. Big oil, Chevron down 1.4%. Schlumberger Oil Services down 1.6%. Murphy Oil, a domestic producer in the pre-market lows, down 5% right now, down 2%. Not surprisingly, what's benefiting the travel trade? American Airlines right now, John, up 1.2%. We've seen this dynamic before. You make a good point on back and forth. It'll be interesting to see how it ends up.
Abby, thank you. One to watch ahead of the opening bell. Here's another one. Ed Ludlow joins us now from the West Coast. Ed, run me through this. Another rocket launch. Right. Now, can you tell me this? When can I stop paying attention to this and just treat this as a plane taking off at JFK heading to Heathrow?
Yeah, it's a really good question, John. For Blue Origin, which is the space startup founded by Jeff Bezos, we're not quite there yet. This isn't quite routine as it is with SpaceX. This is the 4th time that Blue Origin will carry human beings into space, quote unquote, beyond the Kármán line, 62 miles above the Earth, which is the internationally regarded boundary of space. We don't know how much these folks are paying. There are 6 crew members on board. We're on a brief hold right now. If you look on the left-hand side of your screen, you see that H 11 minutes. It basically could be any number of factors, right? It could be the weather. There are a number of teams that are prepping this launch, and they're all trying to work in synchronicity and catch up with each other, and a hold is very normal. But I love that question, John, because the reason I'm here in San Francisco tracking this, we at Bloomberg track this, is there's big money behind it, right? Jeff Bezos has put $1 billion a year into this company. We have no idea how much those folks on your screen are paying. But on the left-hand side, Gary Lai, he is the sub, John. He's been subbed in for Pete Davidson, who was, you know Pete Davidson, right, John? He was going to fly on this mission, but he pulled out, and Gary Lai, who's a very senior executive at Blue Origin, is taking his place. So of the notable milestones that we're looking at this mission, it's a good one for him because he literally designed this entire launch system. So for him as an executive in the industry, this is kind of a full circle moment.
Ed, does anyone feel uncomfortable about this? You know, I've started this segment this morning talking about war in Ukraine, the cost of energy prices. And here are 6 people on a vanity mission to float around in space for a little bit and come back down to Earth.
Yeah, John, 2 things. The war in Ukraine and Russia has put a real spotlight on the commercial space industry. For Blue Origin in particular, because they're not just doing this, their product is not only sending rich people into space for a few minutes, they also hope to be a manufacturer of rocket engines. And for a long time, the United States has relied on the Soyuz rocket, built, of course, in Russia. The Russians have withheld access to those rocket engines because of sanctions. But the other part of it, and I do like your question, John, but the other part of it is that with every rocket launch, no matter who's operating it, there is risk. And when there's human beings involved, there is risk. And while they're supremely confident in the safety of this system, We always watch because there's risk because the propellants used, in Blue Origin's case, hydrogen and oxygen to power the BE-3PM engines. And so you always have to pay attention just for that reason.
Well, Ed, I know you're paying attention, and you'll be back, no doubt, later this hour to keep us up to speed as well. Ed Ludlow there from the West Coast. Coming up, Western allies seeing little reason to believe Putin is de-escalating.
If the Russians were really serious about de-escalating and the way they spun this yesterday, that they're trying to take the pressure off, well, then send them home. And that's not what they're doing, at least not yet.
The conflict on the ground continues for the Federal Reserve. They're trying to shake this off, looking ahead potentially to a 50 basis point rate hike. That's next.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I'm open to it. I think the question, and we'll make this decision when we get to the meeting in May, is how strong does the economy still look in terms of its ability to take rate increases, and how high is inflation persisting? So I'm looking at both of those, and we'll make our call in May.
Everybody else is making that call for them, seemingly 50 basis points in May, then again in June. Mike Feroli of JP Morgan on board with that now. Just getting a headline across the Bloomberg from Vladimir Putin saying the following: we'll continue supplying gas at set volumes and prices. As for prices, let's talk about currency and what have we paid in. Putin saying Russia to halt gas contracts if buyers don't pay in rubles. That just crossed in moments ago. Mike McKee joins us now. Mike, this is a tricky moment for central bankers, managing what's happening with energy and trying to do something as well about inflation with rates.
Yeah, the whole Russia gas situation raises the question of an enormous jump in inflation in Europe. And what does the ECB do? They can't turn on the gas. So it's tough for them. It's also tough for the Fed here in the United States. We got a reminder this morning of why they're raising rates. Take a look at the PCE index. That's the Fed's favorite inflation measure, all the way over on the right-hand side there. Notice how it is now up to 6.4% on a year-over-year basis. The chart shows you that every time the Fed has had to bring inflation down, they move the Fed funds rate above that PCE level. Do we get a 6% Fed funds rate out of this? Well, we're going to get maybe 50 basis points, as John was saying a few minutes ago, because the case for 50 has been pretty much joined by everybody. Bullard and Waller and Mester have said they're on board, and Jay Powell started it off by saying he's willing to go 50 if necessary, and the others who are voting members of the Open Market Committee have pretty much agreed that they're willing to do it if necessary, and today's numbers sort of remind us that they may be. And here's something else that's an interesting reminder. We did see compensation go up this month, wages and salaries 0.8 in the month of February. But even with all of the pay gains that people have been getting, you can see the employees' share of corporate profits, and corporate profits were up 35% last year, the highest since 1950. But the employee share has now dropped down below where it was in 2019, which tells you at this point there's not a wage price spiral going.
Mike McKee, thank you. I know you've got to run to get a plane to go down to DC and bring us payrolls tomorrow, so buddy, you get off. Thank you very much, Mike McKee. Jim Keenan, Brian Nick, Julie Beale back with us. Julie, to come to you. 50 basis points now seems to be the consensus on the street for the next meeting and the meeting after that, and Citi's Andrew Hollenhorst thinks they go again at 50 basis points and again at 50 basis points. Where are you now, Judy? This just feels like a fight on Wall Street between who can out-hawk each other.
Yeah, I mean, I think everyone was a little bit slow to catch on to the concept that inflation was going to be quite durable. And I think everyone now is going to respond. And I think the bigger question is, does the Fed also overreact and create a much, much more painful hit to demand than is expected? I think there's a real risk that the Fed maintains its stance a little bit behind inflation, and we have a period where demand takes a real hit and inflation is still high. And that's painful, I think, and that is really problematic for voters to really think about.
Jim Keenan, what's your assessment of market pricing on Fed action this year?
Yeah, so I mean, we've talked about the complexity. At the end of the day, I think the Fed will try to be data dependent. I think they do have to move pretty aggressively to try to reduce some of those inflation expectations right now. But I think as the market goes, you have to kind of look through what is the easing of some of these supply constraints that you've seen come out of the pandemic. And we don't know the answer to that, right? You know, obviously we talked about Ukraine and Russia. All these things are going to be fairly volatile over the course of the year. And I think the Fed is going to take its tone, in the back half of the year based off of that. The market pricing, though, is, I think, going to be incredibly volatile. Obviously, that inflationary pressures has a huge difference depending on what sector and who's losing and who's winning off of that. But the markets, from a pricing standpoint, are going to continue to debate in almost a tug of war between every inflationary data point. We just discussed PCE, what they think that the Fed should do, other central banks could do. And so I think the risk premiums in the market are going to be pretty volatile. What you've seen in the first quarter already, I think that continues throughout the year.
Brian Nick, I want to share this quote from Deutsche Bank with you. If you believe that asset markets have already largely absorbed the current rate structure and are now priced for a 3% terminal rate, there are good arguments to suggest the terminal rate can go higher still until such time as financial conditions tighten materially. Would you agree with that statement, Brian?
That's the thing that's concerning about seeing, seemingly every week another rate hike get priced in and the equity market continues to rise, credit spreads continue to compress. Yes, we have the inverted yield curve now, especially the short-term yield curve is showing an inversion and the Fed's going to have to be cutting by the end of next year. But I think there's something to this, that if the Fed really wants to tighten financial conditions because they see themselves as basically too loose right now, fostering higher inflation. Their forecast for core PCE this year is 4%, which is double their target. They're going to need to look at how the markets are responding, look at how financial conditions are tightening, or in this case are not tightening, and maybe have to go further. And this is why I think you sort of lose a sense of a limiting principle here. How high does the Fed have to hike? It has to hike until there's some kind of pain that's felt, unless and until inflation starts to come down on its own. So one of the encouraging things about the data this morning was PCE inflation for durable goods, which remember was basically the source of all the inflation from last year, was 0. So the transitory crowd gets a little bit of a victory, maybe a little bit too little too late, as we're about to get slammed by this energy price inflation story in March. But for now, that some of these disinflationary things are playing out. So I think data dependent is certainly the name of the game for the Fed. But until then, as long as they seem like they're willing to continue hiking, that seems like what the markets are willing to price in.
Brian, Julie, Jim, sticking with us into the opening bout. We'll carry on building on this. Headline from Vladimir Putin, the Russian president, just moments ago. Russia to hold gas contracts if buyers don't pay in rubles. That was not the impression that Mario Draghi had getting off a call with Vladimir Putin earlier today and offering us his thoughts on the situation. We'll come back to Maria Tadeo a little bit later this hour on that. Dollar ruble is not much of a market at the moment for many people in this market. I know you've all told me so many times. Euro dollar, though, does roll over by 0.8%, now session lows 110.72. Coming up in the morning calls and later, closing out a tough Q1. Stocks heading for their first quarterly decline in 2 years. That's next.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell, let's get you some morning calls. Barclays downgrading AMD to equal weight, seeing cyclical headwinds across end markets. Citi upgrading 5 below to buy, pointing to the stock's attractive valuation. And finally, Guggenheim raising its Roku price target to 145, highlighting strengthening data in European markets. Coming up on the programme, wrapping up an ugly Q1. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell in New York this morning. Good morning. Wrapping up Q1 and the month of March. Q1 messy, but the month of March has been a big month of gains for the S&P 500, up more than 5% coming into the final trading day of the quarter and the month. Futures down about 0.1% on the S&P. Let's the opening bell, switch on the board and get to the bond market. What a move we've seen across the Treasury curve. On 10s right now, yields lower by a couple of basis points. On the session, your 10-year 233. On the month, your 2-year up by more than 80 basis points in a single month. And here we are with an equity market doing okay. We are about 10 seconds into this session, and your S&P 500 is lower by 0.1%. Energy underperforms, down 0.4% off the back of the move low we're seeing in crude. Let's get you some movers. Here's Abby.
John, let's stick with that energy story because the energy movers really do stand out on the back of that move lower in crude that you were just talking about. ExxonMobil, big oil, down sharply, although off of its lows right now, down about almost 1%. Occidental Petroleum, though, down a little bit more, down 1.5%, with yields in that big surprising move that you're talking about. Morgan Stanley, some of the banks, a little bit softer, not in a big way, down about 0.6%. And yields down usually is good for tech, and we do have some tech names higher, but AMD, as you were talking about earlier, a downgrade. Micron seems to be down in sympathy with that to some degree. Plus, yesterday that stock was up on strong earnings. So across the board, a little bit of weakness here on the open, John.
Abby, thank you. It's a confusing time for energy. So this is what we know so far. A little bit later, we'll hear from the President of the United States on energy and what he's going to do about gas prices. This is what the team here at Bloomberg learned down in Washington, D.C., that they're considering the potential of a massive reserve release. Could be 1 million a day, anything up to 180 million barrels overall. Look out for that. Could be announced as soon as today. In Europe, there's this strange spat emerging between the Russians and the Europeans over gas supply and what currency to secure that gas supply in. Vladimir Putin has said this morning. Buyers of Russian gas should open accounts in Russian banks. New rules for gas payments will be valid from April 1st. Russia pledging to continue to supply gas at set volumes and prices, but ultimately they want those volumes to be paid for in rubles. And not in euros, not in dollars, but in rubles. How can that take place in the current sanctions regime, and will the Europeans go along? And seemingly at the moment, every single European leader has pushed back against this suggestion so far. I'm going to head to Europe a little bit later in about 15 minutes' time and catch up with a colleague of ours to run through the details here. Germany on the wires as well, saying the following. They say gas supplies are stable for now. They will introduce major solar and wind projects soon. The latest sanctions package is not the final one. That's the latest line from Germany. So there you are. The spat continues. As for this market, the final trading day for Q1. Stocks heading for their biggest quarterly decline in 2 years. Want to get to Taylor Riggs for a little bit more. Hey, Taylor.
You know, John, I think my theme for the quarter is it is all about perspective. Now, on one hand, you could say, look, we're looking at one of the biggest quarterly drops that we've had since March of 2020 on the S&P. But look how far that we've actually come back from some of the bottoms. Remember, we peaked on January 3rd. You were down in correction territory as much as 13-14%. Off some of those recent record highs, but you had actually big rebound in March. So we are only closing down 3.5% for the year. A lot of people are actually going to call that a win, given how far we have come back from some of the lows. Really, though, John, as you know, the story is all about the bond market. Change up the board and you can see it is the biggest quarterly increase in basis points and yields on the 2-year since 1984, depending on how today shakes out. Looking at one of the biggest increases this quarter on the 10-year yield, going back in more than a decade. So really, it's all about that rate of change. And it has really been a bond story. Quickly, we'll look at, though, some of the pandemic winners and losers. A lot of the winners that we had since March 2020, those, as we think about the rotation within the S&P, some of those stocks are actually some of the big underperformers. It's Vroom, it's Fastly, and then, of course, Pinterest as well, also another one. Zoom Video off anywhere 20 to 30% as well for the quarter.
Taylor, what did you make of Restoration Hardware and that call that everybody's been talking about? What did you make of it?
You know, I think really interesting. We had a good point yesterday where they clearly have a certain customer, right, John? They are speaking to a certain audience. But if you think about a company and a CEO on that call, using that macro environment to talk a lot about the supply chains, to talk about the inflation, you do wonder if it is that idiosyncratic risk or if those macro comments that he made actually do apply across the board. We're mindful there is a clear customer, though, when it comes to RH.
Taylor, thank you. If you're not familiar with this story, for our audience outside of America, a furniture store which fancies themselves as a lifestyle brand as well. You can go there and hang around a restaurant in New York City if that's what takes your fancy and you're bored on the weekend. You'd have to be very bored, in my opinion anyway. Anyway, they came out yesterday on a call and basically said that things have decelerated materially. To Taylor's point, is it RH specific or is it about something broader? Take a listen to what David Kostin of Goldman had to say on earnings.
There's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. You have these events that have really impeded a lot of sales for a lot of companies, and I think managements have been reluctant to give guidance.
Back with us, Jim Keenan, Brian Nick, Julie Bill. Jim, let's start with you. The outlook for earnings. Goldman's saying expect some negative surprises. Would you go with that?
I would, but I'd say in aggregate, I think it's going to be fairly balanced. I mean, at the end of the day, you know, nominal growth is still going to be good. We are downgrading real growth, but with that inflationary pressures, earnings are going to be tied towards that. And I think you'll see a huge bifurcation between what industries are benefiting from that and what industries are going to get squeezed because of labor costs, input costs, or, you know, even supply disruptions, in which case, as David pointed out, they can't actually deliver the goods. So I think there's going to be a pretty bifurcated story between what you're looking at. But in aggregate, I think the earnings story over the course of the year is actually going to be pretty strong. I think margins ultimately come in a bit, but top line holds as you see a consumer in a decent space, and the labor market continues to be good. I think the consumer in aggregate holds even if it slows. And at the same time, I think business investment will continue just because of the need for resiliency, right? I mean, at the end of the day, we're looking at all these supply chain constraints. Businesses and governments are going to have to invest in more of the infrastructure on some of these secular trends. And so I think that the earnings story is pretty good. And I would say, you know, valuations have tightened up to that story. I remain to think that that's going to be volatile. And so we still like the credit markets because of that, and certainly more on the front end where you reduce some of the interest rate vol.
Julie, from an equity perspective, do you share that more constructive view on earnings?
I think it's going to be much more of a mixed bag. I think there are definitely going to be companies that benefit or can manage through supply chains, those that have differentiated business models that can pass on pricing. But I think ones that are, you know, just kind of your average commodity business that doesn't really have a lot of pricing power, those are really going to struggle. And, you know, I think we all can agree that margins are pretty close to peak. And seeing margin degradation is not typically very good for valuations or earnings. We also have concerns about what's going to happen with buybacks in terms of the new regulations. So I think there's a little bit of a concern of what, you know, earnings growth really can look like. And so for us, trying to find businesses that have earnings durability and resilience is the way to position yourself going forward.
Julie, where are you finding them? Because I think your point is an important one and will resonate with a lot of people. How can you make a forecast in this environment? Jim's speaking to that, speaks to the volatility of the next year or so. You just shy away from it, saying don't even try and make one. Where are you focused?
I think where we're focused is try to find businesses that have enough of an earnings track record that you can see how they behave in an inflationary environment or even in an environment where there's a slowdown in their own industry. If you look at a company, Jack Henry, which serves financial institutions, you look at that business through the financial crisis and it looks like it didn't even happen. That's because it's so central to the operating of any kind of financial institution for which it serves. So that's the type of business that we really like.
Brian, where'd you come down on this?
Well, I think the important story in the first quarter that you wouldn't see by looking at the data is that the economy has generally been quite good. I mean, 6 months ago or 4 months ago, we were talking about Omicron and the consumers weren't going to be able to spend them. That's not what we're seeing. The strongest part of GDP growth in the first quarter will be sales, people buying stuff and businesses buying stuff. And that should be good for revenues. So the question is going to be on the cost side. We did have in the first 2 months of the year, 1.6 million people enter or re-enter the labor force. That's going to take wage pressures off just a little bit. They're still running really high. Aggregate wage growth has been close to 10% over the last 6 months. So that could be a potential concern for profit margins. But where this comes out in terms of where to invest, I still think larger companies more oriented toward growth are going to be the preferred market here as we kind of normalize back down past the reopening phenomenon. And also as companies who probably have an ability to meet those rising wage pressures with offsetting costs elsewhere, have a little bit more room to keep profit margins wide. Small businesses are the ones that are really struggling at this point with inflation.
Brian, since everyone is reluctant to come out with a crystal ball at the moment, can we try that now? Where do you see the economy at the end of this year? I mean, I'm just looking at things play out. Consumer confidence, rock bottom, right? Gas prices, sky high. I'm seeing inflation start to bite for a lot of people. At some point, you'd have to believe that hits activity. We're talking about the top line. I'm wondering when people stop buying, when discretionary spend really gets hit around. And this is what David Costin at Goldman's getting at. He's saying that the earnings risk is around the consumer. Staples, discretionary spending, those kind of things. Do you not share that?
I'm not that alarmed by it. I think the savings rate is still 6.3% as of the end of February. I think energy is going to eat into that, but there's also a lot of accumulated savings on the sideline that isn't captured by that monthly rate. So we have about $2 trillion of extra cash on hand. It's not dispersed equally in the economy. I think the concern this year is that a lot of the growth last year came from people in that bottom 20 to 40% of income earners who spent a lot more money last year than they normally do because of the stimulus, and that money is gone. So we're not going to grow at 5.5% this year, but we could still grow at 2.5% this year on average after a shaky first quarter that I think is going to get dented by inventory decumulation. But in general, I still think we're going to be at or above trend throughout the balance of this year in terms of the real GDP growth. And we end up somewhere in the 2.5% to 3.5% range.
Judy, the eyes in the control room telling me that your head is shaking. I'm trying to work out if it's going up and down or side to side. Which one is it?
I like to be mysterious, you know. No, I think that's a really good point. I think the consumer is such a central driver to the U.S. economy, and it is starting to come under material pressure. And you're seeing that in terms of what's being bought, right? We are seeing fewer durable goods, right? Because more of the budget, particularly of your lower income consumer, is just going to groceries and gas. So I think that has a material impact on the rest of the economy and earnings writ large. And, you know, if you think about what the Fed is doing, right, what's been driving so much of the economy has been, you know, purchases of homes and cars. And I think having an a rising rate environment is hopefully going to slow down demand there. But I'm not sure that you'll see a pickup in durable goods or in the rest of the economy. So I think there's downside risk in terms of the consumer's ability to continue to spend.
Home Depot already having a very ugly start to this year. Home Depot on the quarter down around about 25% so far year to date. Julie, thank you, alongside Brian, Nick, and Jim Keenan as well. Coming up, OPEC and its allies stay in the course.
We have one objective only, which is trying to maintain the supply to the market and ensure that that supply is affordable.
I asked the gentleman, the minister from UAE, why the last meeting lasted 13 minutes. The team reporting the following this morning. OPEC Plus hurried through its last meeting in just 13 minutes without discussing the issue that was dominating global commodity markets. It beat that record by a minute at today's talks. That conversation still ahead.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
If you're trying to follow the gas story out of Europe at the moment, it's difficult. Breaking news in the last 15 minutes, this line from Vladimir Putin of Russia. To buy Russian gas, they need to open ruble accounts in Russian banks. It is from those accounts that gas will be paid for starting April 1st. If such payments aren't made, we will consider this a failure by the client to comply with obligations. I want to catch up with a good friend of mine and ours, Guy Johnson, out of London. Guy, make sense of this. Can you compare and reconcile the comments from Vladimir Putin with what we hear from Chancellor Scholz and Prime Minister Mario Draghi about what they said Putin told them with what Putin is saying this morning?
So I do actually think, John, that they could fit together, and here's how. Basically, you, as a gas buyer, open an account in Russia with Gazprom Bank. You then transfer foreign currency into that account. Gazprom Bank then buys rubles with that money and then buys the gas. It is unclear at this point, I admit, but that certainly fits reasonably well with what we got from Draghi. So I think this is a way of both sides kind of getting what they want, but I still think, judging from what I've read, but I think it is, as you say, unbelievably confusing, and the message is unbelievably mixed. But the text basically says foreign buyers transfer foreign currency to a special foreign currency account, and then the bank buys rubles on the exchange, which is then used to buy gas. Does that explain it? I'm not entirely sure, but that's kind of where I am.
That was better than my effort, guys, so thank you. I guess to stick to the reporting, because if I comment, I'll be deep into the realm of speculation as to what's going to happen here. From what we've heard from the Germans, are they satisfied with the supply, the volume of gas they're currently receiving?
At the moment, I think contracts are being satisfied, but whether or not that is going to be enough to deliver what we need going forward is an open question. John, at this point, when you think about gas in Europe, you need to think about not about what's happening now, but what is going to happen next winter. At the moment, storage is, let's call it circa 25% full. the recent weather has been quite warm, and actually we're back into where we would roughly normally be at this stage in the year. So the tanks aren't that depleted. In fact, they're being refilled right now because the weather recently has been so warm. So we're back to we're not too far away from where we would normally be. Now, the question going forward is, can Europe buy enough gas to get the tanks to where the EU would like them to be? I think it's this year 80% full, next year it's 90% full, but that's kind of the trajectory we're on for at the moment. And in order to make that happen, European prices need to remain above Asian prices, because ultimately the swing factor here is not Russian gas, but global LNG, which is going to fill the gap.
Guy, just a final question from me. This side of the Atlantic, we'll be looking ahead to the President of the United States later. There's this conversation about a monster reserve release. How is this playing out in Europe? As most people assume that there would be a greater effort from this White House to get in touch with Riyadh. Can we just assume that that outreach has failed? And can anyone bridge the gap between Washington and Riyadh? And can that be done out of Europe?
I'm not sure it can be done out of Europe. I think that's going to be something that is going to be tricky to achieve. Look at what happened when Boris Johnson went to the Gulf, didn't come back with any extra barrels of oil, which I thought was significant. And you think about what is happening here as well with the Iran story. Basically, 1 million barrels a day is kind of where Iran would be. So you take Iran out, you put this oil in. But ultimately, John, this is probably going to widen the spread between TI and Brent. It is going to have more an effect in the United States. But long term, as somebody put it, we're going to talk to the Trafigura chief economist a little bit later on. This is a bonus rather than a pay rise, and this may discourage shale from shipping extra barrels or producing extra barrels. And the other factor as well here as well that you've got to bear in mind is that refineries still haven't got the barrels from the previous SPR release. So it's going to take a while for this to come through.
This has been messy for sure. Guy, looking forward to the programme. Starts in about 10 minutes' time. Thank you, buddy. Out of London, Guy Johnson there. 1:30 p.m. this afternoon. Joe Matthew from DC joins us now for more. Joe, this is going to be a big focus for you. What do we expect to hear from this president?
We're going to have this conversation in dollars, Jonathan. You're right, 1:30 p.m. We'll see how close we come to this being on time. Washington time today. As you just referred to, this is going to be a major announcement of a release of oil from our strategic petroleum reserve, but not like the single action that we've seen historically when the president makes a move like this. This is going to be a rolling release over the course of many months, 1 million barrels per month. Sources telling Bloomberg, we don't know exactly how long that will last, but could be a total release, Jonathan, of 180 million barrels. So this is a pretty big deal. The president's done this twice now, tapping the reserve. 50 million barrels back in November, followed by another 30 million in March following the invasion of Ukraine. And as we can see here in the numbers, neither went very far to impact prices. AAA has the national average at $4.24. This all comes down to what you were just talking about, Jonathan. OPEC not budging, despite a lot of effort from this White House to convince them to increase production. So here we are today with an administration trying to do what it can to impact prices.
Joe, the pushback we've had, and we've had a lot on the programme earlier this morning with Tom and Lisa, and again today, just sceptical minds. Why will this make a difference?
It might
Does anyone
not.
think it will?
It might not. We're talking about, there are two different conversations here. Bloomberg, we want to know what this means for prices, what it means for supplies, the global economy. Here in Washington, this is about politics. This is about perception, a White House that wants to be seen doing whatever it can to lower prices for Americans. This is going to be an inflation conversation more than an oil market conversation when the president speaks a little bit later today. Even if it doesn't work, Jonathan, they can say, walking up on the midterms, that we did what we could with the tools we had.
Hey, Joe, we'll see. The market will speak for itself, I'm sure. Joe Matthew, looking forward to the show a little bit later. Joe Matthew, sound on. Bloomberg Radio, 5 p.m. Eastern Time, Monday to Friday. And looking forward to the coverage around this from David Weston as well, going into that address by the president at 1:30 Eastern Time. Crude is lower by 4%. Brent at 108. WTI down 3% at 104. Let's get you some sector price action with Abby.
Well, John, very interesting given the fact that we have that weakness for oil itself. The energy sector is the top sector at this point, right now up about 0.6%, followed by the dividend-rich, sensitive sectors, real estate and utilities doing well as rates are down. And then, interesting, tech and communication services, the worst, down about 0.6%. On the year, it's all about energy, especially for the domestic producers. This is an incredible chart. The index of domestic producers on the year, John, up 52%.
Abby, thank you. Up next, your trading diary. Pushing ahead to Payrolls Friday. It's just around the corner. From New York, this is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The response from Chancellor Scholz. He says the following. Breaking news. Companies must be allowed to pay for gas in euros. That's the response from Germany. Chancellor Scholz saying companies must be allowed to pay for gas in euros. Vladimir Putin, the Russian president, saying this. To buy Russian gas, they need to open ruble accounts in Russian banks. It is from those accounts that gas will be paid for starting from April 1st. If such payments are not made, we will consider this a failure by the client to comply with its obligations. How do you square this circle right now? Guy Johnson's going to do a decent effort on that in about 5 minutes' time. Look out for that. I want to run through your trading diary just briefly. You'll hear from the president at 1:30 Eastern time on energy prices. Friday, the main event. It's Payrolls Friday, plus Fed Speak, continuing with Chicago Fed President Charles Evans. And looking ahead to next week, oil executives heading to Capitol Hill on Wednesday. Then we'll get the Fed's latest meeting minutes. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes.